that, that's all. No problem, Gary. Where am I, Matt? In my basement, just sitting here, Nothing too exciting. Would have been fun to go somewhere fun for the webinar, right? Take a cruise, do the webinar there, but no. Hey, Penny, he won the trade. You just didn't take it. Not his fault. Yep, David, I'm always in the basement. Always in the basement. That's true, Penny. That's true. Oh, nope, nobody's down here that I know of. It's a good sign. Good sign. Did I say something? There's no OD agreement with Nadex regarding funding. That's correct. That's correct. No specials with Nadex. The specials are with the non-Nadex brokers, and we'll talk about that tonight. So it's 7:29 now. Probably going to give it another 5 minutes. Let people get on here. We had about 180 register for the webinar. Pretty huge number in my mind. And we have 62 popped on so far, probably including me, so 61. Will the recording be sent out to our email? Yes, it will. Yes, it will. It'll also be posted on Facebook. All right, all right. Have someone listening in. That works, that works. 181 registered then, 64 on so far. Not bad. Hey, Melissa, how's it going? How's it going? Not a problem at all. Now I know why Roger finds silly music before the webinar, right? He has to talk for half an hour, otherwise he'd have to talk for half an hour beforehand, like I am. Sandy, let's see. Thanks for doing this. Would love your thoughts on other brokers besides Nadex. Don't know which to choose. Yep. We will definitely go over that. Definitely will go over that. Did OD actually have a webinar last night? No, they didn't. They didn't. The webinar was actually kind of sabotaged on our date, but that's okay. Looked like more people could get on tonight anyway. They did have a webinar at 3 p.m. today. I missed it, so I have no idea what happened. I saw Troy sent me a recording before he started drinking, so I definitely watched that tonight. Let's see. Just saying, no. If I kill 69 people all at the same time, I might get in trouble. And, I can't hide your bodies down here, right? So whoever said that. Lisa got the email after it was over. Yeah, Aaron Andrews told me that Hitesh told him, so kind of a chain there, but Hitesh told him it takes 10 hours for the system to send out an email because of how many peoples we have. So, pretty crazy. Does the 2 to 5% of betting apply to Nadex or just the broker account? We'll talk about money management. We will talk about money management, but your money management is going to be very similar between the two, between any of the brokers, including Nadex. Is this being recorded? Yes, it is. Yes, it is. It's actually not being recorded yet. The Q&A's, this pre-webinar Q&A is not being recorded unless Troy is recording it. I don't know, but once we start, it will be recorded. So we're going to get about 2 more minutes here, and then we'll get going. Troy has the last 10 minutes, all right. All right, Gary says the 3 p.m. webinar is pretty good, so make sure you guys check that out too. No, why not? Why not get a phone call? You know, second the webinar is about to start. Let me mute out the phone, guys, and then I'll get the recording set up, and then we'll get moving. So 1 second here. Hey, William, how's it going? Let's get rid of that call. It's Atesh. Maybe. No, like I said, never actually talked to Atesh. Talked to Roger at the event a little bit. That's about it. All right, so let me set up my recording here. So I need everything on the same screen. I'm going to take this part slow to make sure I don't screw it up, right? Just a second, guys. Just a second. Alrighty. All right, and we are recording now. So, hey everyone, welcome to the webinar. Welcome to the webinar. Obviously going to be talking about options domination, binary options training, and on how it all works. So we did a little Q&A before the webinar started. I'm probably not going to be looking at the chat box a whole lot, you know, just because I'll forget moving forward. So we will have a Q&A session at the end. If you guys have an urgent question, go ahead, type it in the box. Maybe I'll see it, and then if I do, I'll answer it, all right? So a quick note, a few disclaimers here at the beginning. It should be pretty obvious, but, you know, I'm not part of options domination's ownership or management, right? So the presentation is a supplement to their training, and whatever I say doesn't necessarily represent what they say, all right? So, you know, just a little disclaimer there, all right? Next slide. So you guys don't care, but a little bit about me. Some of you asked. I'm 23 years old. I'm from Michigan. Graduated from the University of Michigan in 2013 in mechanical engineering. That's where my full-time job is now. Work for the U.S. government. Joined DSD as one of the founding members back in August of 2013, and making roughly $12,000 a month profit off the e-drop shipping right now. So we all know DSD works extremely well. We're all pretty confident that options domination will work extremely well. So once you understand it, you can definitely take it to the same level, if not higher. If not higher, it's just as easy, if not easier, to scale doing the binary options trading. All right. Why do I still have a regular job? Well, because copying and pasting orders doesn't take that long. You can do it at night, and you know, the regular job does pay money too, right? So I don't want to give any of it up. All right. So, and then why should you listen to me at all on this? Well, I do have some Forex trading experience. Did it quite a bit during high school, all right? I was successful at it, but it is time consuming. You know, it's a lot of staring at the charts, looking for possible entry points, looking for good setups, trying to figure out, you know, when to get out if you're losing, when to actually take profit if you're winning. With binary options, you don't have that difficulty, all right? You're out when you're out. You're taking fixed time trades, and, you know, you either win or you lose. There's no watching, trying to time or predict how much it's going to move. You just need it to move. All right. So haven't done Forex trading in a while, but was successful at it when I did. All right. So more disclaimers, and yeah, Michigan, go blue, right? More disclaimers. You guys can read this. I guess legally I should read it to you. I'm not sure, but binary options trading involves significant risk. Although the risk trading binary options is fixed for each individual trade, trades are live, and it is possible to lose an entire initial investment, particularly if a trader chooses to place his entire investment on a single trade. So it's highly recommended the traders choose a proper money management strategy, which limits the total consecutive trades or total outstanding investment. All right, guys, so there's a possibility to lose money here. All right. More disclaimer, just for fun. You must be aware of these risks and be willing to accept them in order to invest in binary options. Big, bold, italic, do not trade with money you cannot afford to lose. This presentation is neither a solicitation nor an offer to buy, sell stocks, futures, commodities, or options, and no representation is being made either by me or by Options Domination that any account will or is likely to achieve profits. All right, past performance is not necessarily indicative of future results. Wasn't that fun, guys? Wasn't that fun? But take it seriously. All right. Yes, we expect the system to work. Yes, the system has worked, historically, but it may not in the future. All right, so just keep that in mind, guys. One more quick note, and then we'll be done with the administrative stuff. Any links discussed are personal affiliate links, all right, and a commission will be generated if you choose to join through them. Not so much that I'm looking to make a ton off you guys here, but you see the broker there in the picture, right, and his big bag of money behind him. We might as well take money from the brokers while we can, all right? So while it's greatly appreciated if you use those links, you're definitely not required to do so. And if you guys have teams or uplines or anything that they have links for you for these brokers that we discuss later on, go ahead and use those, all right? But make sure you use somebody's because, well, that broker has a big bag of money that he doesn't need, all right? So just a quick note, guys, just disclaimer so everything's up front and you guys know that, all right? So what are we going to go over tonight? And guys, let me know if the volume's good, bad, if it ever goes out, and I'll keep an eye on the chat box for that, all right? So here's our agenda for the night. We're going to do an introduction to binary options, how they work. Is it completely necessary that you know exactly how binary options work? Not really, but it never hurts to know what you're doing and why you're doing it, okay? We're going to look at recommended non-Nadex brokers for each signal type. We talked about this a little bit while people were still hopping on, but because of the different signals that Options Domination gives, there's different brokers we're going to want to use for different signals, all right? We want to maximize our profit as much as we can, and we'll talk about that later, all right? We're going to go over placing a trade in a non-Nadex broker. And then we're going to start talking about trading beyond the signal. And what do I mean by that? Well, when we get a signal in options, it says enter at this price, right? We're going to talk about how do we know if we should enter right at that price. Should we look at trade? Should we avoid trades altogether, all right? We're going to look at that. So hopefully we can improve your win rate. Yes, it's a little extra work on your part, but it's not going to be hard. We'll go over it. And you guys should be able to avoid some of the losers, get more of the winners, and even get winners on some of the losers. All right. So when you see red in your Options Domination account, keep in mind that we're going to make that not always a loss. A voice is breaking up. Robert says, "Is anyone else having issues? Is anyone else having issues?" No, yes. No, I'm breaking up too. Yes, off and on. All right, a bit. No, I sound good. Perfect. Yeah. Looks to be about 50-50 here. All right, let me mute the mic and... All right, how we doing now, guys? How we doing now? Any better? Come on, technology. All right, it looks like we're better now. Cool. Yeah, my voice just does that. That's what it is. There we go. So after we talk about that and improving our entries, avoiding losers, getting more winners, we'll talk about money management. All right, a big part of trading is money management. We want to make sure that you guys aren't over-risking your accounts. All right, you need money to make money, and if you lose money, you can't make money because you don't have money. Right? Sounds fun. We'll talk about bonuses and broker bonuses. Should you accept them, how they work, and you know, exactly what you're looking for with the broker bonuses. We'll look at Nadex. Definitely a different animal. So we're going to look at the basics of Nadex. We're not going to go too far and confuse you guys, but we will look at the basics. And then we'll have an optional Q&A session. Pun intended. Ha, 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 right? Okay, so we will have an optional Q&A session at the end. Okay, so well, let's get started here. Only 55 more slides to go, right? What are binary options? So when you guys are trading binary options, you're asking yourself a simple question, all right? A yes/no question. Will the value of an asset being anything like currency, stocks, commodities, indices. You'll see currencies and commodities are bold because that's what options domination gives us signals on, all right? Gives us signals on currencies, currency pairs, and commodities, all right? Still choppy, guys. I don't really know what to do about it. Was it choppy during the Q&A at the beginning? No. Of course. You guys missed that. It's only a little bit every so often. All right, so guys, I don't really know what to do about it. So hopefully we can just fight through it. And if you guys are really having issues, then let me know. All right. But all right, logging back in and out solved it. It's the nature of the software. I wasn't talking continuously then. Okay, so maybe if I talk. Yeah, it might be internet connections. My internet connection is showing as 5 bars green, so should be all right on my end. I'll talk a little slower and see if that helps. But again, we're asking, will the value of an asset be higher or lower than it is now at some instant in the future? All right, some instant in the future. So we need to not only know, will the value be higher, will it go up or down, but will it be up or down at some exact point in time in the future? Right? And that's what makes it a little bit complicated to predict. You'll see, again, currencies and commodities are what we're going to focus on. Commodities are like silver and gold are the main ones that works with. Maybe oil in the future, I'm not sure, but those are what commodities are. So you'll see our little green button that says call or a red button that says put. So if our answer to the question is yes, if we say yes, the value of an asset is going to be higher at whatever point in the future, we're going to take a call. A call is saying yes, the price is going to go up. Okay? If we say no, the price is going to be lower than it is now, we're going to take a put. So you'll see green is a call, up, put is red, down. All right? And those buttons are there for you. Those are pretty similar to what you'll see on the brokers. All right? For each, the cool thing about binary options, one of the cool things, is that for each individual trade, your risk is fixed. All right? You're only going to put a certain amount on the trade. If you put $20 on the trade and the trade loses, well, you only lose $20. You can't lose more than that. If you put $100 on the trade and it loses, well, you might lose $100. Likewise, the risk and potential profit is always known before you enter the trade. All right? So before you click the button to put your money at risk, you're going to know what the risk is, and you're going to know how much profit you will make if you win. All right? So you have all the information prior to entering a trade, and it's fixed. All right? Definitely should help your plan, and of course, help you control your risk a lot more than other types of trading can. Okay? At least on the non-Nadex brokers that we'll talk about, the payouts are always fixed as well. So, you know, that's going to help. Let's see, next slide here. So what's actually going on in binary options, all right? Keep in mind that in binary options, our prediction is happening outside of the actual market, all right? So if you go and you buy a stock, and you buy a stock in the stock market, right? You're involved in the actual market. Your buying of the stock, well, it actually raises stock price a little bit. Not you can't single-handedly raise it enough to matter, but people buying stocks influence the market. All right, an actual asset is being bought or sold in that situation. Well, in binary options, that's not what's happening. And I like to compare it to a presidential election. All right, so inside the circle, you have the guy running for president, right? And you have the person voting for him. All right, the person voting for him is actually influencing the election. He's basically buying. It's like he's buying stock. All right. Now you have the two girls on the left, and they're just chatting. They're just saying, well, they're just talking about who they think's gonna win. Well, the girl on the left obviously thinks that the guy in the circle is cute, and she thinks he's gonna win. The other girl isn't so sure. She's using her head a little bit. She thinks the other candidate's gonna win, right? And maybe they make a bet. All right, maybe they make a bet with each other, and they say, well, okay, if you're right, I'll give you $100, and if I'm right, you give me $100. That's happening outside the market. They didn't actually go to that little vote box and drop in a ballot, right? They didn't cast a vote. They're just making a prediction outside of the market. So in binary options, we're not actually buying an asset. We're just making a wager on the outcome. All right. So in that case, we can't move the market. Okay? We can't move the market. So no matter how many people come on OD and take these trades, we can't actually move the physical market because we're not involved in it. No currencies actually being bought, no commodities actually being bought or sold, etc. All right. All outside of the actual market. Alrighty. So let's talk about binary options brokers for a minute. So if no assets are actually being bought or sold, well, how do the brokers actually make money, right? Well, for non-Nadex brokers, they're basically betting against you, all right? They're accepting your money, taking your prediction, and if you win, they have to give you, a profit. If you lose, they keep your money. So for non-Nadex brokers, probably lose a trade, all right? And it's not quite that simple because, there are people winning trades, there's people losing trades. We'll go over it in a minute, but theoretically, they're making money when you lose. All right. Nadex, on the other hand, they charge fees when you enter and exit contracts, and we'll talk about Nadex more later. But they're more of no physical asset is being bought within the Nadex system. Contracts are being bought and sold, and Nadex charges a fee for that. All right. So that's how Nadex makes money. Nadex doesn't care if you win or lose, and it's just a different business model. All right. It sounds choppy and keeping up with the video. All right, so sounds like the phone service might be working a little better for you guys. So if you guys are breaking up, you guys can go ahead and call in on your phone and then still watch the presentation online. All right. So let's take a look at a non-Nadex broker and how they might make money. All right. So let's say that Jack and Joe both enter the same trade, and it has an 80% payout for the winner. Okay, so you see Jack took a trade. His trade size was $100. His direction was a call, right? And we said on the last slides that if you're taking a call, so Jack, of whatever asset he took, he expects the price to go up. Jill, on the other hand, bet the same $100, traded the same $100, invested the same $100, whatever term you guys want to use. Her direction was a put, so she said, no, Jack's going to be wrong, and the price is obviously going to go down. All right. Trade came to close. When that trade closed out at the expiry, Jack won. All right. Jack was the winner. The price actually went up, and thus Joe was the loser. So remember, the trade had an 80% payout. So $100 back plus 80%. He got $80 in profit. All right. Jill, on the other hand, lost the trade. She lost all $100. Okay, so take a look at what the broker did. They collected $100 from Joe on the loss. Jill didn't get that back. They gave Jack his $100 back, and they gave Jack his $80 profit. So 80 of that $100 went to Jack, and the broker kept 20 of it. All right, and that's more or less how the brokers make money, offsetting volume. All right, they hope to pair the winners with the losers, and they just make that spread in between. All right, so that's kind of how a binary option broker operates. Here's some of the differences between non-Nadex brokers and Nadex brokers. Or not Nadex brokers, there's just one Nadex, all right? So between non-Nadex brokers and Nadex. Brokers are market makers, all right? They're just accepting the trades. They're accepting the risk. And the spread in between payout and the loss is their profit. All right, Nadex is a regulated exchange. So instead of trading against a broker, you're trading against other traders. All right, that's the only difference. And Nadex keeps a commission on each trade. All right, so non-Nadex brokers are a lot easier to understand than Nadex, which you'll see has a higher learning curve. They're both fixed risk payouts. All right, before entering platforms, you're always going to know what you're risking, what your potential loss is. All right. Non-Nadex, they have fixed payouts, so you'll see that when we look into it closer. Nadex has variable payouts, where you can actually earn more than the 80% that we quoted for a non-Nadex platform, way more potentially, hundreds of percentage points, or less. You can take a trade that might give you 10 or 12% profit, and you'll always know that before entering, but the payouts are a lot more variable. All right, non-Nadex brokers, there's no fees involved. They just profit off that spread like we talked about. Nadex charges fees on your entry and exit. There are more currency pairs available to trade in non-Nadex brokers, usually. All right. In order for them to be offered on Nadex, there has to be enough volume. There has to be enough people trading them for it to matter. All right. So Nadex has the main pairs, the popular pairs. Non-Nadex brokers have some or all of the other pairs, all right, depending on which broker you use. On a non-Nadex broker, when you take a trade, if I took a trade right now, I would get the current entry price would be whatever the current price of the asset is, all right? So if I'm trading gold, and I said, all right, I want to take a trade on gold right now, the price I get would be whatever the price of gold is when I click the button, all right? On Nadex, on the other hand, you have multiple specific entry points available. You can't pick any entry point you want, but there's entry points available that you're going to be able to choose from, and you'll see the advantages and disadvantages of that later. All right. On a non-Nadex platform, the layout of the signals matches exactly. So we're gonna go over the signals later on, and you'll see that on a non-Nadex platform, it's entirely straightforward how to take a trade on a non-Nadex platform. Nadex, you're going to have to do a little bit more thinking, a little bit more analysis to figure out if the trade's worth it. But again, on some trades, you could have a much higher payout. All right? So due to the ease of the system, I'm going to start with the non-Nadex broker. But keep in mind, there's a lot of bad brokers out there. So it's important to choose the right ones. Bad brokers means this. A lot of these, or all of these brokers, besides Nadex, are located overseas, all right, in different countries. And when you're located overseas, it's pretty easy, in some cases, to run off with your money or not pay you when you cash out or anything like that. Price manipulation. You take a trade and it should have won, but they made it look like it lost. Stuff like that. So we want to make sure we pick the right brokers that have been tested, brokers that, have actually paid out and will continue to pay out, and a broker that looks pretty just because, all right? Then we definitely want you to demo trade on Nadex until you fully understand using the signals with it, all right? John or Penny or someone will yell at me for not putting the word understanding in there later, all right? So we can take a bet on that. It's coming. All right, next slide. So let's look at a currency pair. What is a currency pair? What are we looking at? All right. So here's currency pairs explained. On a normally what you're going to use a currency pair for is forex trading, and that's where you're actually the currency or selling the currency and making money based off the change in exchange rate. All right. So take a look. Here we have the euro this is the symbol for the euro currency, EUR, over or slash the US dollar, all right? The first currency, or the euro, is called the base currency, all right? The second currency is called the quote currency, and you don't really have to remember that. You don't have to remember base and quote currency, but take a look what it means, all right? So the euro dollar in this picture is trading at 1.47450, all right? And you have two prices shown. Okay, the first price is 1.47450. It's called the bid price, all right? And the bid price is you could sell 1 euro for $1.4745. So if you took a euro and you wanted to exchange it for dollars in this situation, you would take your 1 euro and you would get about $1.47 back, all right? The second price over here, your slash 460, and note these are just the last 3 digits, all right? So 1.47460 is what this would be. This is called the ask price, and this is the exact opposite. You could buy 1 euro for 1.4746 US dollars. All right, so that's just the ratio in the other direction. Now, why is the price different? Why is the price different? Why can I sell a euro and get less US dollars, need a little bit tiny more amount of US dollars to actually buy a euro, right? And that difference, what we call a pip, and we'll go over that in a second here, is called a spread, all right? And that's how a normal Forex broker makes money. They give the buyers, they give you that price difference, that little pip in between, all right? So what exactly is a pip? Well, a pip is going to be our second to final digit, all right? Second to final digit in the number, all right? So that's going to be 1 pip. A tenth of a pip is going to be what we call 1 tick, all right? So it's a really small unit. Pip is a pretty small unit, and that's how we're going to know if we won or lost trades. We need the price to, move by pips, all right? We want the price to move in our direction, and we measure that in pips and ticks, all right? So it's slightly different for binary options brokers. Binary options brokers have a fee involved. They don't have a spread involved. Their spread is in the payout percentage, right? So binary options brokers will typically only display 1 price. And more often than not always, you'll want to check with your broker, and it'll be in their terms or their FAQs or whatever. But usually, they report the bid price plus the ask price over 2, all right? So they report the price. So on a binary options broker, in this case, we would have a price showing of 1.47455, right in between 50 and 60, all right? Now, keep in mind that options domination signals currently report the target bid price, all right? So they report the bid price. Well, we're looking at the bid plus ask over 2. Confusing. Not something you have to pay too much attention to, but just be aware of it, all right? They're using a Forex broker for their price readout, and that's why they're getting the bid price. There's no charting software out there that will report a bid plus ask over 2, okay? So just keep that in mind. It comes from the difference in payout rate, all right? So this is what a currency pair is. How many euros is equivalent to $1 at the time that we're looking at, all right? So that's what we're going to normally be trading. So here's the terminology again. The pip is the second to last digit in a quoted price. A tick is also called a pipette. All right, that's another name for it. I don't like it as much. Tick seems, quicker at least. And a tick is the final digit in a quoted price. So it's 1/10 of a pip. All right. In binary options, now keep in mind, guys, if you were taking an actual Forex trade and something moved a tick, let's just say, for example, that you took $1.4745, 1.4745 euros, all right? And you exchanged it, okay? And the price went up 1 tick, so we went up to 451. Well, when you exchanged it back to dollars, the difference would be so tiny that you wouldn't even notice it, right? I mean, it's almost no change. So when you're trading actual Forex, you need a significant amount of change to make profit, all right? And your profit is based on how much it moves. What's the difference? You're profiting off that change in exchange rate. Well, in binary options, you're just predicting up or down, yes or no, right? So in binary options, a single tick is enough to trade, but it's also enough to lose a trade. All right. So it sounds nice. Oh well, I only need to win by a tick, and I get an 80% payout. Right? Very true. Very true. And that is nice. But you only need to lose by a tick to take a 100% loss. All right. So just keep that in mind. A little win is equal to a big win. A little loser is equal to a big loser. All right. Let's look at currency pairs a little bit more, and don't get intimidated by all the letters and all the pairs. All right, guys, we're gonna make a point out of this in a minute. But there's two types of currency pairs. All right, the first one is called, and usually, actually not usually, this is what it is. A major pair contains the U.S. dollar on one side. Why? Because the U.S. dollar is one of the most traded currencies out there. All right, it's what pretty much everything's based off of. So a major pair is if it has the U.S. dollar on one side. So you see, we have the euro going to the right. We have the U.S. dollar over the Canadian dollar, right? And you'll see how the U.S. dollar isn't always on the same side of the pair. That's going to be important later, all right? We have the New Zealand dollar, U.S. dollar. The U.S. dollar, Japanese yen. The U.S. dollar, Swiss franc. I don't know why the Swiss franc is CHF. I don't know what CHF. That is the Swiss franc, all right? The Great Britain pound, U.S. dollar. And the Australian dollar, U.S. dollar. Cheese. Yep. Well, there we go. Might as well stand for cheese. Why not, right? Now cheese sounds pretty good. I haven't eaten dinner yet, guys. So, oh well, have some cheese later. All right. So now if it doesn't contain the U.S. dollar, we call it a minor pair. And I'm not going to go through and read all these. These are just all the same currencies, but no U.S. dollar. All right. So instead of the euro dollar, we have the euro pound. All right. But keep in mind that these aren't traded as often as the major pairs, okay? So likewise, remember that our brokers, our binary brokers, be it Nadex or a non-Nadex broker, needs trading volume to profit, all right? Non-Nadex, they want an equal number, roughly, of sellers and buyers, and, you know, that's how they mitigate the risk. And, well, if nobody's acting and one guy comes on and trades the currency, well, they don't want that, all right? So the major pairs are going to be offered far more often than the minor pairs. All right, and so when we look at brokers, we're going to want to make sure that we have brokers that can handle our major pairs, which almost all of them can. All right. Holy crap, Pikey. If I knew those two words, I might say them. But guys, if you wanted a lesson, look in the chat box, and that's what CH stands for. All right, I'm just going to keep calling it the Swiss franc. All right, so difference between a major and minor pair. So we also want a broker that can accommodate us when options domination gives us a minor pair. When they say go take a trade on the Swiss franc dollar yen or the Swiss franc Japanese yen right here, we want to be able to take that trade. We don't want to log into our broker and say, oh crap, you know, they don't even offer it. That was no fun. We want to be able to take the trade because remember the win rates are based on all of these pairs combined, right? So, you know, we don't just want to be stuck taking the ones that were offered. We want to be offered as many, and we'll look into that later. The other things that we're going to be trading over here are commodities, so gold. And gold is also listed, gold is listed as gold, and silver is listed as silver on most of the non-Nadex brokers, all right? But options domination is using, again, a Forex readout. So gold is going to be listed like this. The XAU, and again, I don't know why that's gold, but XAU is gold over the dollar, all right? Silver is XAG. You would think that would be gold, but it's not. Silver is XAG over the dollar, all right? And that's so if you get a signal on XAU over the U.S. dollar in you're going to want to know that's gold. You're going to want to know this is silver. And then oil is just oil. I haven't seen an oil trade yet on options domination. So, you know, it may or may not ever come. I don't know. Okay. Now, generally speaking, like we mentioned, there's more volume on the major pairs. All right. The euro dollar is by far the most traded. And I think it's roughly 3 times as much as anything else. So it's the most traded. But again, those major pairs are heavily more traded. All of them are heavily more traded than the minor pairs. All right. So another thing what we'll look at is you're going to see more trading volume on those pairs. You know, bigger movements a lot of the time, stuff like that, all right? So just keep that in mind. Major pair, dollar on one side. Minor pair, no dollar on one side, all right? So now, let's look at a signal. What exactly is a signal? Well, inherently, an up, down, or a higher, lower, or a yes, no is 50-50, right? Is it going up or down? Well, you know, it's a coin toss, right? If I was just to guess, if I was to not look at anything right now and say, well, the euro dollar, I think it's going to go down. Just a complete guess, it's a 50-50 shot. Might go down, might not. But remember, the payout percentages offered by the binary brokers, you know, 70, 75, 80%. Well, that's not a high percentage for a 50% win rate to be profitable, all right? So if we were to just win 50% of our trades, just take yes-no propositions all day long, we would lose money. We'd lose a lot of money, all right? A winning signal provides you with a recommended trade that is expected to win at a high frequency to generate a profit over the long term, all right? And as far as options domination goes, the signals are either generated by algorithms, so by a computer, or trading professionals. And they're generated when market conditions are favorable. All right, guys? So remember, we don't want to take trades just for the trades. So it doesn't help to go in the options domination group and post, oh, there hasn't been a signal in an hour or 2 hours or 3 hours. All right? You know, where's my signal? I paid for it. You don't want a signal just for the sake of having a signal. You want a signal because it has a higher than necessary expected win rate. So if the market doesn't give anything that the software or the traders think have a higher than expected or higher than necessary expected win rate, well, you don't get a trade. And you don't get a losing trade, and you don't lose money, right? So keep that in mind. When we get a signal, we want it to be expected to win rate to profit long term, all right? So here's the anatomy of a signal. I guess we'll look at a signal like a body part, right? This is what a signal looks like in options domination. When it first pops, it won't be green like this. Green background means it won, or red background means it lost. But the first column is the asset, and that's the currency pair, commodity, or stock that we're going to be trading, all right? Again, usually a currency pair like we looked at before. The direction is either going to be an up arrow or a down arrow. It's a put, or back up. The up arrow is a call, all right? So up arrow is call. We're expecting the price to go up. A down arrow is a put. We're expecting the price to go down, all right? Pretty simple there. The strike price is our next column, and that's the price that the system recommends we enter the trade at, all right? You want to get exactly the strike price, underlined here, underline's important. You want to get exactly the strike price or better within reason. We'll talk about that in a minute here. But you want to get exactly the strike price or better. Never take a trade at a price worse than the signal strike, all right? Why? Well, because the signal strike in this situation, it says, hey, we expect the price to end up at and higher than 119.818, all right? 19.818 or lower, and it ends higher than the 818, you're going to win no matter what. If you take it higher than the strike price, well, it might have already moved up as much as it's going to move up, and then if it moves back down at all, domination, their signal might win, and you take a loss. You never want to lose when they win, because it's completely avoidable, all right? Should never lose when they win. All right. Next column is signal time, and that's when the signal was generated. Now, by default, guys, that's in GMT, Greenwich Mean Time, something like that. That's the time zone it's in, GMT. All right. And most of the non-Nadex brokers report their times in GMT as well, so it'll match up. All right. And you'll see this one generated at 1300 GMT. Oh, now, guys, if you don't know what time GMT is, I know that for Eastern time is 4 hours behind GMT. So 12 p.m. here right now. So it's like midnight, a little after midnight GMT at the moment. If you guys don't know, here's a link. It's timeanddate.com. And if you go to that link, you can use it to compare time zones and figure out when GMT is. All right. The expiry time is when to set your trade So this one popped as an end-of-hour trade. Well, if the trade signaled at 1300 GMT, and we want a trade to expire at the end of the hour, when's it going to expire? Well, 1400 GMT, right? We want it to expire at the end of that hour. So we would pick a 1400 GMT expiry. All right, and we'll look at that in a minute here. The date is just the day the signal was generated, nothing too fancy there. And the expiry price, when it actually closes out, the price at expiry, the price at the expiry time determines if you won or lost. So take a look. We're at 119.818 here. That's where you were supposed to enter at for it to go up. When it closed out, it was at 119.997. So 818.997. The 997 is clearly higher than the 818, and the trade won, right? So nothing too hard there. Now, one of the common questions is, well, why is there two strike prices on options, right, or on the signal? Well, this is something Atesh came up with, and the first price, the 119.818, outside of the parentheses, outside of the brackets, is the price when the signal first generated, all right? The second price is updating, and it's saying that based on, current market conditions, it thinks the price there might actually be an entry available at some point during the trade that's a little bit lower, all right? And a lower entry is better when we're looking to go up, right? So it's saying that, if you wait, if you sit on your hands a little bit, you might be able to get a 798 entry instead of an 818. And that'll obviously increase your chances of winning. So what you'll see sometimes is, a trade loses. The 119.818 might lose. Maybe we close at 119.800. All right? Well, the 119.818 would lose, and options domination would say, hey, this is a losing signal. But if you would have got this price in the brackets, well, 800 is higher than 798, and you would have won. All right? So there is a possibility, and it happens more than you might think, to win on what OD calls a losing trade. All right? So just because it's red doesn't mean it necessarily lost. Sometimes it does, but it doesn't always. And you can look at those prices and see, well, if I got the better entry, would I have still won? All right. So that's how a signal looks in options. Now, guys, I want to be real clear about this, because within my team, there's been some confusion when I say this. You have to enter a trade exactly on the hour. No. So you actually have to get into the trades at least 5 minutes before they close out on most brokers, all right? So you have from when the signal pops until 5 minutes before it's set to close. So you have like 55 minutes roughly to do it, all right? And you can take it right away. You can take it time into the trade. It doesn't really matter. It's when you get that strike price or better, that's when you take it. All right. So, split trades, we'll talk about that in the money management later on. So, split trades are an option as well. So, yep. So what exactly is a better entry? All right. There's a lot of confusion about this, and I want to make sure that everybody has this down. Okay. So, a better entry means that if you enter at a price, if the OD signal wins, you win. Absolutely guaranteed you win. All right? You see a post of, hey, this trade was green and I lost it. No good. All right? A better entry also means that if the OD signal loses, you may still win. You may lose. More than likely you'll lose if the OD signal loses, but there will be times that the OD signal loses and you'll win. All right? So what does a better entry mean? On a call, we're looking for the price to go up, right? We're looking for the price to go up. So on a call, we want to get the strike price or lower. Why? Because if the price is higher than the option signal, even if we took a lower price, the closing price is still higher than it, right? If a price is higher than a higher price, it's higher than our lower price, and we win, okay? So on a call, we want the strike price or lower. On a put, we want the exact opposite. We only enter puts at the strike price or higher. And you guys will have this recording. You guys will have this presentation. So if that doesn't make any sense, go back, think about it, and, you know, watch it a couple times, and it'll make sense. But calls, you only enter strike price or lower. Puts, you only enter strike price or higher. Now, if the price doesn't meet this criteria, you stay out of the trade. But it's no fun if we don't give Troy something to edit, right? If we don't give Troy something to edit, he's going to be bored, and he's just going to have a perfect recording, and we don't want that. So, Troy, there you go, buddy. So, all right, guys. So, if, I'm not sure where I cut out, but if the price doesn't meet this criteria, we stay out of the trade. And basically what that means is if you see the signal a little bit late, and the price has already moved in our direction, in the winning direction, well, you stay out of the trade. All right? That's not a big deal. You just missed one. For longer-term trades, maybe for the end-of-hour trades or end-of-day trades, you can wait and see if the price becomes favorable again and then get in later, right? So maybe we're looking for a call and the price moved up above our strike, all right? Well, if the price is recommended strike, we can't take it yet, but maybe some point within the hour, the price will pull back down. And, you know, that's kind of not entirely nice, right? You're kind of rooting against the people who did get in on it, but eventually we want it to win anyway, right? So if it does pull back down, then, you know, feel free to take it, get in on the trade at a price worse than the recommended strike. All right, got it? Let's move on. So more on better entries, pounding this in, don't want bad trades. So a price should only be better if it is still likely that the OD signal will win. All right, this is kind of one of these things where we're talking about it a little bit early, but where we can stay out of losers. All right, so I've seen a couple times in the you know, groups where someone will say, "What, I got a 50 pip better entry than the signal." Well, that means the trade moves so far in the opposite direction against the signal that the signal was probably wrong. All right. Yeah, so OD is options domination. All right, OD is options domination. Just shortening it up a little bit. All right. So if it moves so far against you before you see it and before you've gotten in, you know, don't necessarily jump on it and say, "Holy crap, this is an amazing entry." Just think about the possibility that maybe this trade was wrong. Remember, we're looking for something above a 56% win rate to profit. All right. Options is not OD is looking for, you know, 62, 65, 68% win rate. So if over a third of the time, we're going to be wrong. All right. And if we can avoid getting into some of those wrong ones, we can improve our win rate dramatically. All right. So take a look at our example. By the time you see a signal for an end of hour call on the euro dollar, so we expect the signal wants the euro dollar to go up by the end of the hour. It has already dropped 50 pips from the recommended strike. Do you still take the trade? All right. The answer to that is no. You don't still take the trade. Why? Because odds are the signal was wrong, right? And if we already know the signal is going to lose, then we're just getting in on, well, hope that it goes up. Maybe it will go up from where you enter at 50 pips down, but it's not really based on the signal. And that's what we want to do. So we only want to get in if there's a good expectation that the signal is still likely to win. So a better price is good, but a way too better of a price is bad. All right. So just keep that in mind. It is possible though, and we'll look at it later, to take a trade like this on Nadex for a high potential payout if there's still a lot of time before expiry. All right. There's a lot of time for it to come back up 50 pips, and you can get a 5-to-1 return, 500% return on Nadex. Well, maybe you can still take it there. But on our non-Nadex brokers, something like this, we're going to stay out of the trade. And here's probably our second rule of the night. All right. If a signal looks like a clear loser before you've entered, skip the trade. All right. Skip the trade. Nothing wrong with skipping the trade. Okay? So now that we've talked about trades for quite a while here, how about we actually take a trade? That'd be fun, right? So give me 1 minute. We're going to look at a non-Nadex broker. We're going to look at a non-Nadex broker, and we're going to see if we can potentially take a trade. All right? Give me 1 sec. I'm going to have to share my screen so that you guys can see that. Just logging into it. So what we're going to do is we're going to look at the current we're going to look at the options domination signals. All right, and there is and Penny's leaving, so I lost. Penny's leaving, but we're going to look at the current options domination signals and see if we can get a real one. All right? We'll make one up. All right. So let me share the screen real quick. How am I going to do this? Desktop, share monitor 1. All right, guys, you know the drill. You guys are going to tell me if you can see the screen. Bouncing up and down here. Chat. Yep, see the screen? All right, awesome. So what we're looking at here is a non-Nadex broker. Don't worry about which broker right now. We'll talk about brokers later, but a non-Nadex broker. I'm also going to log into options domination and look at the signals. All right. We don't actually have a signal right now, unfortunately, because it's like the middle of the hour, of course. They usually populate at the beginning of hours, right? But and the signals look pretty good recently, 3 and 1. But so let's make a signal up. If we were going to look at this, let's look at a loser signal, just because maybe we can still get the entry, all right? Our asset on this signal is the US dollar versus the Canadian dollar. All right? So if I'm looking at my broker, all I need to do is pick the asset. And this broker doesn't actually have that asset. It's not available in the drop-down list. And that's what we talked about later on, or that's what we talked about earlier on, that we will talk about which brokers to use in which situation. So in this particular broker right now, if this signal popped, we couldn't take it. So here's one, the Great Britain pound US dollar. That is that's not in our drop-down list either. All right. Can you maximize the screen to make it easier to see? Yes, we can do that. Now keep in mind, guys, I can't see the chat now. No, now I can. All right. So let's move chat over here. I don't know if you guys can see the chat. There we go. All right. So let's find one we can actually take on this broker. And you'll see this should be giving you a foresight of why having multiple brokers is going to be necessary. All right. So here's one we could take: the U.S. dollar, Japanese yen. So we would take the asset and we would just change it to U.S. dollar, Japanese yen. All right. Now, this is already in the past. All right. But remember, at the top of our broker, right here, it shows us the time in GMT, and I said it's just after midnight in GMT. So right now it's 00:27 GMT. All right. So let's just pretend that instead of this saying a 1700 time that the signal popped, that's just the time at the signal time again, right? So instead of saying 1700, let's say that this said 0 or 1200 or 1200 would be what it would say. No, it would say 0. All right. So it would say 0 would be right now for this hour, and we're looking for an end of hour trade. So we want it to expire at the end of the hour we're currently in. We're currently in the hour of 0:27. So the next hour is 1. Right? So we're going to set our expiry time to 100 GMT. All right. Now we were looking for a call on this asset. So we're looking for it to go up, and our strike price was 119.506. All right. So take a look. All you do, you pick an asset. You pick your expiry time, which is given by the signal. You put your amount in. How much are you going to risk on this trade? So we'll say $20. All right. I don't know. That's going to be based on your personal money management that we'll talk about later. All right. And then you look at whether it's a call or a put, and it was a call. All right. But now we got to look at the price, 119.506. Looking for a call. So test time, guys. If I can find the screen. Yeah. All right. So test time, guys. If we're looking for a call on the U.S. dollar Japanese yen at 119.506 or better, 506 or better, price is currently 724. Would we take this trade? Yes or no? Yes or no? I see a lot of no's. I see a lot of no's. I see a couple yeses. All right, guys. No. The answer is no. We would not take this trade. Why? Because if we took this price of 718, right? Is 718 on a call better than 506? No. Because remember, based on our rules, we want a strike price of 506 or lower to take the trade, all right? So right now, we would not be in on this call. We would say, okay, it's way too high at the moment, way too high. We still have half an hour left. We still have 25 minutes left before we have to be in the trade. So we could sit here. We could say maybe it'll come back down. But right now, it's so massively in the money by 22 pips or whatever that, you know, the pips, the value, right? So the pip is this 2 here. It's 22 pips from 50 to 72 in the money right now. We wouldn't take it and wait potentially to come back down. Why not take put instead of a call? You won't take a put instead of a call because the system, options, domination, said you are taking a call. All right? You are tied. You're not. But if you want to get the win rate that options says, then you're going to have to go in the direction they say. All right? We don't have any basis to take a put on it because we don't know. All we know is it's going to be higher than 506. Higher than 506 closes. All right? That's all we know. So we want to know that it's too far. It's too far into the money. It's too far into the money right now. All right? It's too far into the money. So, let me see if I can get this. Is it possible to make the screen larger? My screen is optimized, so I don't know. it's as big as I can make it at the moment. But so mine is maximized. So we would not take this trade, okay? But let's say that we got a different price. Let's say that instead of 506, let's say that instead of 506, we got a signal to take a call at 806, all right? And we come on here and we say, all right, well, 806 or lower is what we're looking for, 806 or lower, and we're at 713. Is that good? Is that good? Yes, because we are at the strike price or lower. So where's the line that we draw? And we say, well, we're too far out of the money right now to want to take this. Well, you know, we'll talk about that a little bit more later. It's personal preference. But right now it's about 10 pips out. 10 pips out with half an hour to go. You know, we don't want to trade off these junky charts. We'll look at nicer charts later, but you can see the relative movement. You know, it's moving quite a bit, all right? It was way up here at 755. It still has time to move, all right? So we're going to get a better price. So if we take this trade, if our strike was at 8.0 and we're at 7.0, looking for a call, you set your asset, you set your expiry time, you set your amount, you hit call, and then it'll give you a trade, all right? So, you know, just for learning purposes here, guys, I didn't point it out on the presentation, but, guys, this is a fake trade. It's a fake trade, all right? It might win, it might lose, and don't put money on it, guys, all right? Don't putting anything on it if you ever account. It's really no demo this trade. It's a completely made-up trade. But if you were to take this trade, you would just hit the apply button. It'll process the request, ask us if we want to approve it. I'm going to approve it. And then if we come down here, it'll show us our trade, all right? It'll show us the strike price and the current rate, all right? Non-Nadex brokers are sometimes a little bit clunky, all right? So you'll see right now that nothing's moving, right? Everything's just stuck. It's dead. That might be because the market's stuck, but it might also be because sometimes non-Nadex brokers just freeze up, all right? If it freezes up, you can just refresh it, and this will start updating again. So we're about 27 minutes from the closeout, and you'll see that if it's gray, if it's gray, our strike price is equal to our current rate. If it was to close there, we would tie. We would take a tie. And on most brokers, on 99% of brokers, a tie is a tie. You would just get your money back. No win, no. There are some brokers, remember, there's bad brokers out there. Some brokers that count a tie as a loss. You do not want to be a part of those brokers. All right? Even if the payout percentage is a little higher, you'll get ties more than you think. Not a lot, but more than you think, because the market will freeze up, especially on shorter term trades. Tash just talked about 60-second trades in there, and there are 5-minute trades in there and stuff. So if broker counts a tie as a loss, get out. You'll see if this little thing is green, our price is higher than the current strike on a call, all right? And we're in the money. We're in the money. If it was to close right here, right now, we would win, right? Now, if it's red and the price is lower than our current strike, or than our strike on a put or on a call, if the price is lower than our strike on a call, we would obviously lose. And that little thingy would be red, all right? So we'll come back and see if we're winning or losing. Again, guys, remember, this is in no way related to the success or not success of the platform, whether this wins or loses, all right? This was just a random, shot in the dark trade, just to show you how to walk through a signal and how easy it is, right? How easy. One more time. Set your asset, set your expiry, both given by the system, right? Pick your amount, just type it in the box. Pick your call or put, again given by the system, and hit the apply button. Can't get much easier than that. And for that, on a $20 trade, right, if I was to win this trade, I'm going to get a 76% payout on this trade right now, all right? So you'll see the potential profit is $35.20. The potential payout is $35.20. That's including $20. So for doing those few clicks and putting $20 on it, if I win, I'll make $15.20 profit. All right. Obviously, if I lose the $20. And that's just how that works. So now, let's see, what else do we want to go over? You'll see how these payout rates vary a little bit. So 76% there, 73% there. We're at a weird time of the night where there's not necessarily as many pairs available as usual. And you'll see that right now we're ranging between 3 and 76%, all right, on this broker. Different brokers are better at different times. Different brokers are better on different pairs. And the payout percentages will vary. Usually we're looking between 70 and 80. We'll get an 81 or an 82 or an 83 or even an 85. But, 75, 80% is really where you're looking, okay? Now let's do one more test before we go back to the presentation, all right? One more test here. Right now, our price is frozen at 696. Our strike price was 708. Tell me, A, if we're in or out of the money, and B, how far in or out of the money are we? Round it to the nearest pip. All right, round it to the nearest pip. How many pips are we in or out of the money? Ready, set, go. 696 is going to be the number we go off of. Okay, we're out of the money. Out by 1.2 pips. Good job, Jim. Good job, Jim. Out by 1.2 pips. All right, not a whole lot of answers there, guys. Out by 1.2. All right, starting to come in. Maybe a little bit more typing than before. Out by 1.2 pips. All right, and it's good to be able to do that math to be able to see, what kind of correction do you need to actually win the trade? All right, and you'll see right now it's basically, it's pretty much flat, right? It gray went down a little bit, it came back up a little bit, no big deal. And we'll come back and check on this later. All right, so now let's go back to the presentation here. Once I figure out how to do it, stop sharing. Okay, now I can't see the chat. Okay, there we go. Can you guys see the presentation again? All right, awesome. Cool. So again, that trade was for demonstration purposes only, but what you should see is how easy it is, right? How easy it is to enter that trade on a platform, all right? No big deal at all once you know what you're looking for. All right, now we get to get into some of the fun stuff, all right? Looking beyond the signal. So the signal tells you a strike price and up or down, right? But we've already talked about that we can hopefully look into it a little bit more and analyze whether we think we can get a better entry, whether we think we should take the entry where it is, is it going to shoot right up into the money? Is it going to be profitable right away? Then we want to get in right away, right? Otherwise we miss. Is there a chance it pulls back a little bit first and gives us a better entry? Or should we avoid the trade completely? Does the setup just not look good? And again, this is optional. This is optional. Optional is a pretty good word for options trading once again, right? But your results, all right? So don't get flustered by it. It might not be completely straightforward, but just you're gonna have to practice. You're gonna have to play with it, and we'll go through it one by one here. All right. So step one, easy. Avoid the news. Avoid the news. Avoid the news. Avoid the news. And here's why: the algorithm scanning the market for favorable setups cannot foresee upcoming news releases. Remember, these are ratios of currency pairs, right? So the news affects the value of these pairs, right? If the president comes out and says something that makes our economy weak, well, the dollar is going to suffer from that, and the pairs with the dollar attached to them are going to, be moved in one direction or the other. So we want to be aware of this, all right? News can cause sudden, unpredictable, powerful movements that can throw your trade out of the money, all right? And for us, we don't really know. We don't really, news happens so quick that we don't know. We're not listening to the news, first of all. We don't know what the news said. And this isn't just your news on the TV, all right? These are more official releases market. You don't know what it said, and we're not knowledgeable enough to know what that's going to do to it. So this can be particularly detrimental to trend reversal trades, which is a lot of what DS or what OD gives us, trend reversal trades. We'll talk about what that is in a little bit here. But the news can hurt us a lot, so we want to just stay away from it. So here's another rule, all right? Lots of rules tonight. Here's a rule. If news happened within 20 minutes prior to a signal, or is scheduled to happen sometime prior to the expiry, so it either happened in the recent past or it's going to happen when we would be in on a trade, we're going to skip the trade. Skip the trade completely, and we're not going to let the news throw us out of the money. Now, how do we find the news? Here's a link right here, forexfactory.com. And I'm not going to switch to share the screen because it takes a while just to show you what that looks like. But the news releases are on there, and it just says, what time the news releases are, what pairs they're on, whatever. But we're going to play a more simple rule, all right? Our rule is if there's any news at all, whether it's on our pair or not, during when the trade would be or just prior to the trade, we're going to stay out of the trade. So write down this link, or you guys will have the recording. Before you enter any trade, what do? You're going to go to factory.com and see if there's news, right? If there's news, skip the trade, all right? So that wasn't too bad, right? That wasn't too bad. That's going to keep us out of some losers right there. Nothing that none of you can't do, all right? So next is we want charts. We want to set up some charts, and we want to actually be able to look what the market's doing while it's doing it, right? We want as much information as we can, and while it's nice to have a system that gives us positive expectation, we want to be able to look at a little bit more and try to improve upon it, right? So one thing you're going to want to do is set up your own charts, and here's how you're going to do it. Again, you guys will have the recording, but charting software will allow you to see the price movement for the currency pairs you're looking at in real time, all right? So a link to good beginner charting. It's called CTrader, and we're just using a price readout by this Forex platform, Trader's Way, all right? Price readouts are pretty similar amongst any broker, any platform, all right? So you're going to download this, and then you're going to open a demo account just to see the charts. All right? You're not actually going to trade in this demo account. You're just going to open the demo account to see the charts. So don't fund a live account, guys. You don't need to. You're just trying to get free charts here. And these charts will let us play with things, let us add different things to them. And we'll look at them in a little bit here. All right? Tutorials to set up your charts. And let me go back for 1 second here. What you see here on this picture is a bunch of what we call candlesticks. All right? And each candlestick represents a period of time. All right, and it says it up here in the corner. You guys probably can't see it. I don't know how big it is for you guys, but this is the euro dollar. So the euro dollar currency pair I've been talking about all night. And you'll see this H1. This is a 1 hour chart. So every one of these bars represents 1 hour. All right. So take a look at what an end of hour trade is. Right. An end of hour trade is saying, well, if a trade popped here at the end, and on this chart, if it's this black color, then the pair moved up. The price moved up during that time period. If it's the white color, then the price moved down. All right, and that's all you gotta know. Trying to predict in an end of hour trade, we're gonna take it at the right near the end or the end of this candle or the beginning of the next one, and we're gonna try to predict, is the next candle gonna be black? Is the price going to go up, or is the next candle going to be white? All right, and that's all we're looking for. So how do we actually read these candlestick charts? Should we use charts from Nadex? I don't know if Nadex has the nice charts that you'll get off the actual charting software. I haven't actually seen them, so maybe I'm going to recommend you use those charts just because. But yeah, all right. So if they look nice like that and you can do a lot of stuff with them, yeah, sure. And any readout's fine. All right. All right. So how do we actually read a candlestick chart? Here's kind of a picture of a candlestick chart, and I'm not using white and black on mine. I'm using green and red. All right. Green and red is, more commonly accepted, and to me it looks cleaner, and you'll see that on a chart later on. But here's what we're looking at. So if we have a green candle, I'm breaking up again, boo. Guys, I don't know what to do about it, but just fight through it. If everybody's having issues, then put a bunch of yeses in the box. But if not, then we're just going to have to keep going. Sounds good on my end. I don't know. Sounds clean, not here. Good for me. All right. So if we have a green candle, here's what we have. A green candle means the price went up, all right? So the price opened here. When the candle first started, the price opened here, all right? The price then moved up, and it closed at this line here. The fat part of the candle gives us the open price and the close price, all right? These lines on the candle, what we call the wicks, the lower wick and the upper wick, is how high or low the price moved throughout the candle, all right? So the price started here. At some point during the candle, it moved down to here, all right? And then it moved back up, and we don't know what order this happened in, but at some point in time during this candle, the price got down to here. The lowest low of this candle is the bottom of this wick. And at some point in time, it got up all the way up here, the highest high. All right? Are we supposed to see your mouse? We can't. Okay, that's not fun. Yeah, I would like you to be able to see my mouse. So let me do this. Let me share the monitor again. All right. And so what I'm going to do here, guys, is come over here and put my chat on this monitor and figure out where the heck we were in the training here. Candlestick charts. How do I get rid of the notes? The test bar and slideshow. Okay, guys, tell me. Let's see. Display settings. Swap the presenter view. Okay. So maybe this works. But now I can't. Let's see. Show the taskbar. Stand by, guys. 1 second here. When we reached up, so at some point in this candle, so our candle opened here, all right? Candle opened here at this bottom line. This is the open price. At some point, it moved down all the way to here. This wick, this downward wick shows our lowest low, all right? At some point during the candle, it also moved all the way up to here, the highest high. Just gives us an upper wick, all right? And then it came back down and it closed right here. This was the close price. So the fat part of the candle shows us our open price and our close price. And if the candle's green, it means the price went up. So obviously it opened here and it closed up here. Same thing with the red, but now it closed red, so it moved down. So it opened here and it closed here. All right? And that's all you got to know about the candlesticks. Nothing too hard. So the fat part of the body shows our open and our close. The wicks shows our highest high and lowest low. And if it's green, it went up. If it's red, it went down. All right? No big deal there. Let's move on to the next slide. So using these candlestick charts, let me pull the chat back up. Using the candlestick charts, we are going to do some technical analysis. All right? What is technical analysis? We're going to look at the charts, and we're going to try to find different patterns or find different things that we can use to predict what the chart or what the price is going to do moving forward. All right? So you don't have to be an expert at reading charts, but we're going to go over the basics of some of these things. We're going to look at trending versus trending market. John's going to yell at me again, but see, now I can fix it. Trending versus ranging markets is what we're going to look at. The difference between a trending and a ranging market, and we're going to look at something called a Bollinger Band. All right? We're going to look at support and resistance lines. We're going to look at trend lines and channels. We're going to look at the idea of a retracement. And we're going to look at some of the correlations between pairs. And we can use all of these as possible confirmation that an OD signal is good, and, you know, increase our chances of winning trades, all right? So let's move on to the next one. So first off, a trending versus a ranging market. In a trending market, the price is generally moving in one direction, generally up or generally down. All right? Pullbacks or partial retracements are fine. So if it's moving up generally, and it moves down a little bit and then starts moving back up, that's okay. But a trending market, we're going up or down, all right? So in an uptrend, we're making higher highs with those candles and lower lows. So each candle, the highest high is going to be higher than the last high, and the lowest low is going to be, and the lower lows are going to be obviously lower lows. Yeah, we'll look at the charts again pretty soon, all right? I don't know if I'll go exactly over setting up exact charts, but we'll go over that a little bit more, all right? So in a downtrend, we have lower highs and lower lows, all right? And that's how that works. So in a ranging market, the price, so compared to a trending market, in a ranging market, the price is generally moving between specific highs and lows, all right? Not exactly, but, you know, roughly the same highs and same lows. So we're not setting new highs or new lows for the time period we're looking at. And the market movement will appear to be horizontal or basically sideways. All right. So let's take a look. So here's a trending market. All right. Here's a trending market. And you see that, you know, we go up, we come down. We go up, we come down. We go up, we come down a lot. We go up, we come down a lot more. We go up, down, right? And generally speaking, which direction is this moving in? You see our line here. Generally speaking, price started here, it goes 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 here. Generally speaking, we are moving down. Uptrend is higher on both lows and highs. Did we have another typo in the chart? Uptrend, yes. Okay. Yep, so an uptrend is higher highs and higher lows, all right? A downtrend is lower highs and lower lows. Nice catch, nice catch. So here's, so this is obviously a downtrend. The market is trending down, all right? Alternatively, this is what we say, what we mean when we look at a ranging market, all right? A ranging market is we're moving along, and we kind of come down here, and we say, the market says, oh, well, time to go back up. Then we come up here, and the market says, oh, time to go back down. And we kind of get to these same points, and we're ranging. The price is, it's a good word for it. It's literally ranging between this line and this line. And every time it gets up near that line, it comes back down near this line. Up, down, up, down, up, down, right? And there's no clear direction, right? We don't know with this price right here in the middle here, right in, almost center of our two lines, we don't know if it's going to go up or down, all right? It's ranging. There's no clear direction on price, okay? So, time for another rule. They give us some trades, and you'll see this in the signals table. It shows the type of trade, all right? So for the mean reversion trades, which are labeled as MR1 and MR2, and the trend reversal trades, Hitesh said that the signals work best in ranging markets, all right? Ranging markets. So if the market is trending strongly, you're highly, avoid those trades, right? If you're not in a ranging market, we don't want to take a trade that works best in a ranging market. And that's an easy way to look at the graph, look at the chart, and see, if we're in a trending market, well, we don't have as high of odds of winning, and we stay out of the trade, all right? So here's kind of a chart that, puts the two together, right? Here, the market's ranging, right? Here it's ranging. We go from here, hit it again, it came back down. It's ranging. Here it's trending up, right? Then it started ranging again. Then it's trending down. Then it started ranging again. Then it's trending down. So you'll see that for our trend reversal strategies, in these ranging sections, it'd be okay to trade. Here in a trending section, we don't want to trade. All right. And why is that? Well, these signals are predicting a reversal. It's predicting something to stop going up or down, right? And well, if something's really strongly moving down, there's no indication that this is going to stop going down. Other than it's gone down so far, maybe it'll turn around. But other than that, there's really no indication. So, you could have taken it here. You could have taken it here and said, oh, well, it has to turn around now. Nope, has to turn around now. Nope, has to turn around now. Nope, has to turn around now. Look how far it's gone. Nope. There's nothing telling you that's going to stop, all right? Maybe it will, maybe you win anyway. But, we're better off in a ranging market where we have some idea of where the price is trying to get to, all right? There's an indicator called the ADX, all right? And we'll talk about indicators later. Basically, an indicator is just some kind of mathematical mess that you don't really have to know about, and it draws pretty lines on your charts, either on them or under them or whatever, and it tries to tell you what the market's going to do. So one indicator is called the ADX, the Average Directional Index. Why isn't it the ADI? I don't know, but it's the ADX. And I don't know how it works because I didn't look at how it works, but the general rule is this. If the ADX is less than 25, then that's a good ranging. All right. So instead of having to look at all the lines, all the candles, and saying, well, is this ranging or is that ranging? Or it should be pretty easy to tell. But it's easier to look at this line. It's one single line, and here's our 25, right? And if it's below 25 in these circles, we know the market's ranging. So take a look. Here, we cross below our 25 line on our ADX, and, well, we're in that ranging section, right? Here we are again, ranging. Here we are again, ranging, right? Here, we're above 25. We're at like 46, right? And, well, the market's certainly not ranging. It's trending, right? So that's something that you can use on your charts when you're looking at these trend reversal trades to decide, is it trending or is it ranging? Do I take the trade? So 25 or less is trending. And this shows market volatility, all right? Now we're going to look at something that you guys probably saw in the OD training videos called Bollinger Bands, right? Another indicator. These ones are actually on the chart themselves. And I think we missed a slide. Or the slides are out of order. Let's see here. Yep, slides are out of order. Always fun, so give me 1 minute here. Let's move this chart up here. All right, back to the presentation. So Bollinger Bands are what we're going to look at. And Bollinger Bands are used to measure a market's volatility. Let me pull the chat back up here. Market's volatility, all right? The bands contract where volatility is low, which means they're closer together when volatility is low, and they expand when it's high, all right? So take a look. Here, the volatility is low. The price isn't moving a whole lot, you know, up, down, kind of within a tight range, and the bands are really close together, right? It expands when the volatility is high. So here, our volatility is real high. We're moving up pretty dramatically, at least, especially compared to what we were, right? We just went up, 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 and the bands expand. They get wider apart. They get farther apart. The bands are also flatter when the volatility is low. You see they're almost horizontal here, and they're more sloped when it's high, all right? So in a ranging market, what are you looking for? You're looking for more narrow bands. You're looking for them to be almost horizontal. They don't have to be exactly horizontal, but, you know, these are pretty horizontal, right? So in a ranging market, narrow horizontal Bollinger Bands. You can add those to your charts as well. Just another confirmation. Now, not necessarily as important, but just a little bit of information here. There's two main strategies when trading off the Bollinger Bands. So you can kind of use the Bollinger Bands as another signal here and see what, kind of look at what options domination is looking at, right? Here's our two main strategies. The first one's called the Bollinger Bounce. And what happens is if the price hits one of the bands, right? So the price reached the top of the band. It closed right on the top of the band, right? What's going to typically happen, all right? What's going to typically happen? Well, the price is going to, these are, you know, basically walls, all right? They're meant to be walls. And the price hits the band, and the price says, oops, I hit the band. And what does it do? Comes back down, all right? That's called the bounce. It bounces off the band. Now, does that happen every time? Does anything happen every time? No. But that's one strategy, all right? And you see over here we hit, and we came back down as well. Here we pretty much hit the band. We closed right below the band, and you know the candle came down, all right? And that's kind of what we're looking at with the bounce. And the other strategy called the Bollinger Squeeze, all right? And here's how the Bollinger Squeeze works. Well, we have really far apart Bollinger Bands, all right? You know, we can't see the chart over here, but there was probably downtrending, right? Now, the bands start to squeeze together and the market starts ranging, okay? Market starts ranging. We're in a ranging market again, right? Horizontal bands and pretty close together. But eventually, so here the price bounced off our band like we said, but here the price closed above our line, right? The candle breaks the upper band. Well, then what happens? Well, the price basically says, hey, I'm free, right? I broke out of this mess. And look what it does. It goes up, 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 right? So typically, not always, but typically when the Bollinger Bands are broken, price tends to break out in that direction, all right? Price tends to break out in that direction and move pretty strongly in that direction, right? Why? Well, because it's been trending for so long. Price isn't going to stay in this little bubble forever, right? And once it gets out of that bubble, it's the market deciding which way it wants to go, right? The market's kind of tentative here. Market doesn't know what it wants to do. Oh, we want to go up. Nope, we want to go down. Nope, we want to go up. Nope, we want to go down. Nope, we want to go up. Then the market finally decides, okay, hey, we want to go up. And up it goes, right? So here the market's tentative. Here it finally made its decision, and we went up, 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 all right? Likewise, if we broke it to the downside, we would expect price to go down, down, down. Again, not every time, but you know, it's a strategy, all right? Next thing we're going to look at, so those are our trending markets, our ranging markets, our Bollinger Bands, and our ADX, right? So, a lot to take in, right? But you guys will have the recording, and when you think about it, it's not that bad. All right, next, support and resistance. So support and resistance lines show horizontal levels in the market that price has trouble breaking through, all right? Price tends, but not always, never always, it tends to bounce off these levels in reverse directions. And again, that's going to be called the bounce, all right, a bounce play. If the level is broken, price often continues strongly in that direction. And we're going to call that the break again, all right? We called it the squeeze last time, but these lines aren't going to squeeze or contract, so we're just going to call it the break, all right? broken support levels become resistance, and broken resistance levels become support. So let's take a look what that all means. Okay? So here's a chart. So you'll see we're going to call support a floor. All right, support's going to be a price floor, and resistance is going to be a price ceiling. So you see on this chart, price came up, and then it came down and it hit this area, and then it went back up. Right? Came down, hit this line, went back up, came back down, hit this line again, came back up, came back down, hit this line again. It actually broke the line, but it closed above the line. Right? This is just our lowest low. This is where it closed. Came back above the line, went up, came back down, hit the line again, couldn't break the line yet, went up, 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 came back down, hit the line again, still couldn't break the line, went up, and etc. Here it kind of tapped the line, right? Here it tapped the line again. Can't get out of that line. Cannot break that line. It's a brick wall, right? Same thing at the top. Hit the line, came back down. Hit the line, bounced off it. Hit the line, bounced off it. Hit the line, bounced off it, right? So we're looking for support and resistance levels that have been tested a lot. The more a support level or resistance level has been tested without breaking through, the stronger it is. Why? Well, because we've seen over and over again that the price bounced. So the odds of it bouncing next time are higher than if, it only bounced once. Right? We can't call this a support level. It only hit it one time. So if it gets down there and breaks it, it's no magic. But here, it keeps hitting that price, keeps bouncing. And we can look at that, all right? So some rules. Support is good for calls, right? If we see an options domination signal pop here, right, pop somewhere right around this line, and we say, well, geez, look at that. If it pops here, and we say, geez, well, look at that. That's right near a super strong support level, right? We expect the price to bounce, so we're not going to want to wait for a possible lower entry. We're going to want to get in and catch the price bounce, right? We also can say, hey, that's probably that is one confirmation that the trade is good. We're right near a big support level. Now, if we're right near a big support level and OD says, hey, take a put, well, you might want to be a little nervous, right? Because, hey, we came down here. We're right by the support level. They say take a put. Well, what do we expect to happen? We expect it to the support level and go wee up in the other direction, and we would lose our put, right? So if we can find a support or resistance level around the trade, then that's a good idea to, that's a good confirmation for the trade or bad confirmation for the trade. So support, our price floor is good for calls because we expect price to bounce up off of it. It's bad for puts, obviously. Resistance is good for puts and bad for calls. All right, not too bad there. And here's where support and resistance can become interchangeable. All right, these lines are walls, and if you walk through a door, so if you open up your door and you walk through it, well, it's still a door, right? And if you try to walk into it from the other side, you'll still bounce off of it, right? That's probably how Troy's feeling right now. He was drinking a little bit before the presentation, so maybe he's walked into some doors since. I don't know, but here's what we're looking at. Oh, water. Okay, guys. Troy's claiming innocence. That's good. Drinking water. Water's good. So take a look, guys. Here we have a support, right? We came down, we hit it, we bounced. We came down, we hit it, we bounced. We hit it, we bounced. We bounced. Then the price finally broke through it. And what did we say about breakthroughs? When price breaks through, price likes to, break through. So it broke through, and it went wee, and it shot down quite a bit. Steady downtrend, shot through the. But take a look, when it came back up, it hit our wall again. It bounced off our other end of the wall. So now our support became resistance, right? Support became resistance, hit it there, bounced off, and down we go, right? Same thing here. Broken resistance, boom, resistance, boom, became support, right? It broke through it, came down and hit it, and up she goes, right? So even when the level's broken, the level is still important, all right? Oh, Angela's got to go to work. Alrighty. Have fun. Definitely get you the recording when it's out, all right? So have a good night, Angela. All right. So that's support and resistance, and keep in mind that those levels are channel, all right? Next, we can look at trend lines, all right? Trend lines and channels are what we're going to call them. And a trend line is basically an angled support or an angled resistance, all right? So take a look at this uptrend. If we draw a line here, all right, if we draw a line here, and to create a trend line, here's what we're going to do. We're going to locate two major tops or bottoms and connect them. Nothing hard. So we located a bottom here and a bottom here, and we connected them, and we formed a line. All right? And you can see what price does. Price comes to our line, and it hits it, and it bounces up. Comes to our line, and hits it, bounces up. Comes near our line, bounces up. Up, up, hits our line, bounces up. Hits our line, bounces up. Same type of idea, but this is in an uptrend, right? This is in an uptrend. And you can imagine now that if we get a call, if we get a signal for a call right here, and we say, well, look at this trend line that's been beautiful for a while. Well, we can use that as a confirmation that price is, possibly ready to go up. Will it happen every time? No, but it's confirmation, right? And the more confirmations we get, the better chance we have at winning a trade, all right? Same thing with the downtrend here. We took two peaks and connected them, and, we hit this peak, we hit that peak, we came back down, then we hit a peak, we hit our line again, and down she went, right? Now, eventually she broke the line, right? Broke the line. Proof it doesn't happen every time, but, basically angled support. All right, and what we can do is we can use that to create a channel, all right? And a channel, to make a channel, we're going to take our trend line, we're going to draw a line parallel to it at the same angle as the trend line, and we're going to move it to where it touches the most recent peak. If we had a trend line up here, if we had a trend line down here, going to draw a line at the same angle, move it to our most recent peak, and now we have a channel that the price is moving within, all right? Price is moving within the channel. And again, now it's basically like having support and resistance, right? It's like having resistance. And we come up, we hit our line, we came down. We came up, hit our line, came down. Hit our bottom line, came up. Hit our top line, came down, right? And that's how channels work. And you can have up channels, channels in an uptrend, channels in a downtrend, or sideways channels. Sideways channels are basically just the support and resistance we talked about before. All right. So trend lines and channels act as levels of support and resistance. Now, keep in mind, sometimes price will only be respecting a trend line at either the bottom or the top, and a channel won't apply. All right. So, kind of here, here price really isn't respecting anything at the bottom, right? Need a bottom line because it's not going to tell us anything. Same thing here. We're not really respecting anything at the bottom. So we have our top lines, all right? So a channel won't always apply, but when it does, it gives you support and resistance levels. Now, keep in mind that the two lines of a channel must be parallel with each other to qualify for a channel. Hit the market however you want. Right? You can't just say, well, I'm going to line here with this line down here and make a down channel. You can't do that, all right? The lines have to be parallel, okay? All right, so that figures out support and resistance, or that finishes that off. So the next thing we're going to look at is what's called a retracement, all right? So very large movements face or pull back in the opposite direction in the short term, all right? So now this is one of those, well, it might happen or, but it might not, all right? Why? Well, price is obviously trending up. So before we said, well, we're in an uptrend. Price should go up more than it goes down, right? So now we're saying, well, it might retrace. It might go in the other direction. So this is one of these things that you look for, but you can't bank on it completely. It can't be the only thing you look at. But in order to look for retracement, you must be sure that the momentum has stopped in the trend direction before entering a trade. Right? Make sure the momentum has stopped. The current candle should close with very little or no wick to retrace. We'll look at that in a minute. And we want to pay attention to relative candle size. So how big we're guessing for a retracement on compared to other candles. Now, guys, this cannot be the only reason you enter a trade. It's useful, but it's only useful if you pair it with another type of confirmation. All right? So let's take a look at a retracement. Here's a chart. And you'll see our start point up here. And our price went down, right? It went down, big candle, big candle, big candle. And take a look. We said we were going to look at the relative size of candles. Well, look at the relative size of these three candles compared to the relative size of the candles that happened before it. Here's a mini candle, super mini candle, mini candle. This candle's still, way smaller than these two, these candles are all way smaller than these, right? So this is a big movement, a big fast movement, and the relative candle size is pretty big. So we can expect eventually a retracement. But do we want to take it here because it dropped out a lot? No, because we don't know momentum has stopped, right? And what did it do? It kept dropping. You know, I expect it to still drop. But what did it do now? It closed out here, it came down, and it finally started to retrace some of the wick. All right, it started to retrace a little bit and closed out here. Then it started to drop a little bit, and it's continued dropping, but it didn't create a newer low. It was the first candle in this. It didn't create a newer low. It got down here, it got close, but it didn't create a newer low, right? Then it came all the way back up and it closed here, right? Then the next one came down, but it didn't create a newer low again. It's our second new high. Then it started coming back up a little bit, right? And here's where you could guess for a short-term retracement. Now, guys, it has to be a short-term retracement because we're in a downtrend, right? So what happened? It retraced. Cool. It retraced. This might have been a signal, a reversal signal. And we would have won our... But remember, we're downtrend. So then what did it do? It said, oh, I'm in a downtrend. I need to go down. And down it went. All right? So retracement is a strategy you can look for. But you got to practice with it to get used to how it works, all right? All right, and our last, I'm sure you guys love chart strategy for the night, and we won't even really have to look at charts to do it. It's called a correlation, all right? And currency pairs often correlate with each other. So knowing these correlations, you can gain confirmation for a trade on one pair, say the euro-dollar, using the charts. As a general rule, if the US dollar is on the same side of two pairs, they will usually move in the same direction. So for example, the euro US dollar will generally move in the same example as the Great Britain pound US dollar. Why? Because the dollar is on the back side of both of these pairs, right? So if the dollar is affected, it's going to affect them in the same way. All right? The opposite of that is if the dollar is on the opposite side of the two pairs, they will usually move in the opposite direction. So for example, the euro US dollar would move in the opposite direction as the dollar Japanese yen. Usually. Not always, but usually. So why? Because the dollar is on the opposite side. It's really that simple, guys. All right? And here's a correlation chart. Looks pretty, right? And here's the link that you guys can go to get to this chart again. Right now, I've selected screenshot the euro dollar, right? Just because it's the most common. Different time frames. How much does the euro dollar correlate with these other pairs? How often does it move in the same direction? Now, I'm not really worried about the last hour, the last day, or even the last week, or the last month, right? I want to know, on average, long term, what's the correlation, right? So you'll see the euro dollar, if I look at a pair that has the dollar on the backside again, the Australian dollar, US dollar, we see all this red, right? All this red. So it positively correlates. They usually move in the same direction, strong red, right? If I look at another one, is that the only one on here? Okay, here's the New Zealand dollar, US dollar on the back side again. Again, all red, right? Positive correlation. But if I look at one with the dollar, say the US dollar Swiss franc, or the US dollar Japanese yen, we see it's opposite, okay? It trends oppositely. So if the euro dollar was moving up, then the dollar yen would be moving down more often than not, right? And you can use this chart. You can change which pair you're looking at, and it'll show you the correlations to all the other pairs. And here's the link to that. All right. So you can actually look at other charts, and you can say, all right, well, if we expect the euro to go up, the euro dollar to go up, well, maybe I can have a dollar yen chart up at the same time. And maybe I see something that confirms that the dollar yen is about to go down, right? So if the dollar yen is about to go down, that's confirmation for me to go up, and I can use that as confirmation for my trade. All right. That's the end of our chart analysis. All right. We looked at what, 4 different things or so. Hopefully that helped. Now, quick little interaction. Give me a yes, that made sense, a no, none of that made sense, or some of that made sense. Ready, set, go. Got a sum, got a sum, got an all, got a sum. All right, not bad. So you guys learned something. Yes, made sense. Some, yes, all made sense. Not quite clear as mud. All right, so a little bit of confusion. That's all right. Made sense. Have to watch it again. Right, guys. So guys, you can definitely go back and watch the recording again, and we'll look at some charts in a little bit here. Obviously, we've got a while, but you guys are all still here. It's 50-50. All right, that's not bad. You watch it again. 50, right? Oops. Let's come back up here. All right, so let's get away from the hard stuff for a little bit. Let's get away from the hard stuff and talk about the easy stuff. Let's talk about money management. All right. You guys, the first step has to be, and well, it's nice to say, well, if I take a trade, and I put $2,000 on it right now, I can make 80% of that. I can make $1,600, and that's probably more than most people make in a week at work, right? But our first step has to be don't lose money, all right? Don't lose money. We want to be trending upward in our balance and not have a chance to destroy our account, all right? So money management, even if you use every price action tool we've discussed today, along with the options domination signals, you will lose trades, right? How many times did I say stuff maybe sometimes happens, but doesn't always, right? So you'll often lose many trades in a row. So our goal is to reduce variance by letting the options domination win rates play out, right? We know that Hitesh tells us, hey, these ones win 62%, these ones win 65, these win 68, or whatever, right? 70 sometimes. But we need to give that a chance to play out by taking a lot of trades. Over 100 trades, we're going to lose at least 30, probably 35, right? Probably, maybe even 38, 39, 40, right? We could lose 35 in a row, and we don't want that to kill our account. It's unlikely, but it's possible, and we don't want it to kill our account. So, big rule here, big thing to remember, any string of trades can lose. So plan for it, right? Any trade, you're planning for the worst, you're planning for a loss, and you're making a money management strategy accounts for that, all right? What's called a martingale. And a martingale, well, we'll get to the punchline, it's that. In a martingale system, you increase your trade size after each loss. So if you took a $10 trade and you lost, your next trade would be $20. You lost that, your next trade would be 40, then 80, then 160, then 320, and before you know it, 640, and now you're broke, right? Even if you have a giant $10,000 account, you can only lose maybe 8 in a row, 7 or 8 in a row, before you're broke. And you will get losing 8 in a row sounds like a lot, all right? And in any 8 trade sample size, you're unlikely to lose all 8 of them, but we're talking about taking hundreds of trades forever, right? For the foreseeable future, and eventually an 8 losses in a row is going to happen, all right? So the way the system works is you double your trade size. After a win, the trade amount is returned to its original. Over a bunch of groups of trades, you're eventually going to lose. So martingaling cannot overcome a losing system. If your win rate isn't high enough to profit by taking flat trade sizes, then martingaling can't save it. You'll still lose, and you'll actually lose faster. Even with a winning system, martingaling can still wipe out your account, all right? What if we lose, 10 in a row? Well, we could win. We could still end up with a 60, 62, 65% win rate over 200 trades, but we already wiped out our account. We don't get to take the rest of those trades because we're broke, all right? So, though the risk of ruin for any single event is small, it's a mathematical certainty to happen eventually. So we get another rule. Don't do this. Don't do this, all right? So here's flat trade sizes. Here's what you're going to do. Flat trade size is equal to a fixed percentage of your account balance. All right, so you guys are going to do 1% per trade up to 5% per trade. And it depends what your risk tolerance is. All right, so 1% is conservative, and it's exactly what you should be doing for new traders. All right, we're starting on a live money account. Nothing wrong with starting on a live money account, but Be conservative about it, all right? 1% is perfect for new traders. 5% is pretty aggressive even for experienced traders, all right? My personal rule, 2% is a happy medium once you're in the brokers, all right? So thus, if you're following a 2% rule, a $1,000 trading account or a combination of accounts that add up to $1,000 would allow for $20 trades, right? A $10,000 account would allow trades, okay? And now you're going to want to recalculate your size, but not after every trade, all right? Because then if you win, then your next trade would be bigger. So we don't want to do that. We want to recalculate our trade size weekly or monthly, not daily or after every trade, all right? And again, recalculating is just 2% of whatever our balance is. And we water our money tree and we grow some money and we're good to go, all right? So that's your money management. Nothing too bad. And that's going to be the same on non-Nadex platforms as on Nadex platforms, all right? Your trade size is going to be the same, all right? So back to the brokers. Let's talk about brokers for a minute, and let's talk about bonuses. Now, this only applies to non-Nadex brokers, all right? Nadex does not offer bonuses. It's not offer bonus. Nadex brokers will offer you a bonus when you deposit. And they usually come in two forms. Either a deposit match, where say you deposit $1,000, they might offer to give you somewhere from a 25% bonus. So if I deposited $1,000 and they gave me a 50% bonus, I get $500 for free, right? My account would start at $1,500. They gave me a 100% bonus, my account would start at $2,000, right? I get $1,000 on my $1,000 and I'd be at $2,000. Or they might give you risk-free trades. And a risk-free trade says, all right, you get to take a trade for whatever amount they say, and you usually get more than one. If you win the trade, you get to keep your profit. And if you lose the trade, they won't actually take the money away from you. They'll give you your money back, all right? So if I take a $100 trade and I win, I'll get my $80 in profit. If I take a $100 trade and I lose, they'll give me the $100 back. I didn't actually have lost anything. But here's the trick. Here's the catch. By accepting a bonus of any sort, you usually agree to meet a trade volume requirement before you can cash out anything. So before you can cash out your deposit or your bonus, do a little bit of chart editing here, or you can cash out your deposit or your bonus, either or, you have to meet a trade requirement. And it's typically 30 to 40 times the bonus amount. So if you were to get 100% bonus on a $1,000 deposit, get $1,000 for free, you typically have to trade 30 to 40 times that amount. So let's say 30. Let's say you would have to trade 30 times 1,000. You would have to trade $30,000 in trades before you can cash out anything at all. All right? And wins, losses, and ties all count towards the trading requirement, right? So the bonuses can also usually, we'll talk about this in a minute, usually be accepted on as well, not just your first. So if you deposit $500 and later on you say, all right, I get this, I want to deposit $5,000. They'll usually offer you a bonus on the $5,000 as well. All right. Now, bonuses. When do you accept bonuses? Before accepting a bonus, you must meet these three requirements. Number one, you must understand the trade requirement and exactly what amount it applies to. All right. What amount it applies to. Does it apply to just the bonus amount? Does it apply to the entire deposit amount? Is it a risk-free trade and it just applies to the amount of the trade you lost? You want to make sure you understand the bonus and the trade requirement so you know exactly what amount you're going to have to trade, right? You need to not need access to the funds at all for the next 6 to 12 months minimum. Okay? Why? Well, you can't withdraw. All right? And we don't know exactly what your bonus requirement is going to be because we don't know what broker you're using, but you need to not need the funds for a good period of time. Now, earlier we said you shouldn't be trading with money you can't afford to lose anyway, right? Shouldn't be trading with money you can't afford to lose anyway. But if you're planning on using it for cash flow or something like that, well, then you wouldn't want it. And number 3 is the big one. Know that if trading goes south, which it could, you could lose the entire deposit. Why? Because you can't jump ship. All right, if you put $10,000 in an account and you accept a big bonus, and you start out and, a month goes by and you just can't win a trade, right? And say 6,000. You can't say, I don't like this. This sucks. I'm going to withdraw my 6,000, take my hit, but walk away with something. You can't do that with the bonus because you haven't cleared your bonus, your trading requirement. So when do you accept the bonus? When you understand it, completely, when you don't need the funds, and when you trust the system, understand it's going to, or believe it's going to work, and understand that if it doesn't, if something changes and it doesn't, it's potentially gone. All right, you're going to have to trade your way out of it. All right. Obviously, if you go broke before you clear the bonus or before you clear the trading requirement, well, you're just broke. You're out of money. All right, can't withdraw anything if you don't have it. Okay? So that's how a bonus works. Now, let's talk about Nadex. Who's excited to talk about Nadex? John, can you refuse the bonus? Yes, the bonus is completely optional. You do not need to take a bonus. Okay? Personally, and this is, everyone has a different opinion on this, right? Personally, take the bonus. I figure I'm only depositing money that I want to trade with, and it's usually a big percentage. It takes a lot of trading to up your account 100%, or 50 or 25 even. But so I personally like the bonuses, but you have to realize why the broker is giving you the bonus, because the broker expects you over the course of whatever the trading volume is, they expect you to lose some money, right? It's just, if you don't have a system that wins, then over that many trades, you're going to lose money, all right? So keep in mind why they offer it, understand how it works, why it works, and you meet those rules, then go ahead and take it. If not, respectfully decline it, right? All right, so now for some Nadex. Nadex is a regulated binary option exchange in the United States. Keep in mind, we didn't call this a broker, okay? It's open to the other countries. I have no idea what those 40 other countries are. You'll have to look. But Nadex is an exchange, not a broker. So instead of taking trades against the broker, instead of the broker assuming the risk, we're taking trades against other traders. So when we win against a non-Nadex broker, is this available in New Zealand? I don't know. If you go on Nadex, you'll be able to see what the 40 countries are. Seems like that would probably be one of them, but I'm not really sure. So on a non-Nadex broker, we take a trade. If we win, we take money. If we lose, we give money to the broker. On Nadex, anytime we win, some other trader loses, and if another trader wins, that means we lost. All right. So is the trade being taken against the broker or against another trader? And for Nadex, we're taking it against another trader. All right. Now keep in mind that we saw how easy the other platform was, right? We saw how easy the other platform was to take a trade on, and Nadex does have a lot bigger of a learning curve than non-Nadex brokers, but it's going to be a necessary tool in your trading arsenal, all right? Even if it's, and you start with non-Nadex brokers, right? Even if it's confusing tonight, though, for Nadex, whoa, geez, what the heck? You're still going to want to learn it. Sorry about the half burp or whatever that was. All right, so let's take a look at Nadex here. Some Nadex benefits. So some trades offer, yep, I'm not sure what that was, Krista. Oh, well. I caught it on video, too. Great. So some trades offer much higher payout percentages than non-Nadex brokers. 80% trades, 80% payouts are high, right? Nothing wrong with an 80% payout, but some trades on Nadex can be much, much higher than that, hundreds of percents, giving you potential even with the lower win rate. All right, so we don't necessarily have to win 56% of our Nadex trades, depending on which ones we take. Gail, why does Hitesh only highly recommend Nadex? Hitesh only highly recommends Nadex because Nadex is the only one that is actually regulated in the United States. All right, it's the only one that's actually regulated in the United States. Does that make the other ones bad? No. It makes some of them bad, and we'll talk about the brokers later on. But it makes some of them very bad. But as long as we stick with the good ones, we're fine with the non-Nadex brokers as well. All right. So he recommends Nadex highly because it's completely regulated. All right, and it's based in the U.S. Yep. So again, we don't necessarily need a win rate of 56% to profit on Nadex. Now, you could need a higher percentage. It depends which trades you take, and we'll look at that in a few minutes here. So you also have the ability to win trades that you might otherwise lose in a non-Nadex platform. You have the option to close a transaction early and avoid a late spike against your trade. One thing that's always is when you're in the money for, the first 58 minutes of a trade, and then it starts going against you, and you end up losing. You say, what the heck? Remember, we're only looking at a specific instant in time, so if it's up the whole way and then it's not, you lose, right? You can usually close transactions early on non-Nadex as well, but it's almost never beneficial to do. All right, on Nadex it is sometimes beneficial to do. It gives you a chance to get into trades that are already in the money when you see the signal. We talked about on the non-Nadex platforms, we talked about if you go in and you see a strike price, if you see a price higher than the strike price on a call, you're forced to stay out of the trade, right? We don't want you taking that trade. Well, on Nadex, you actually have a chance to still get in the trade at the strike price, and I'll show you that in a little bit here. But I'll note on Nadex, there's fewer tradable assets. There's fewer tradable, sorry guys, phone going off again, fewer tradable assets on Nadex, all right? Again, if Nadex offers the trade, exactly, fewer tradable assets, because, again, they need traders trading again. So if nobody ever trades, or that fewer people trade, they're not going to offer them. They're going to offer the higher volume trades on higher volume pairs, and that's just what they're going to offer, all right? So fewer tradable assets. You're not going to be able to take every signal on Nadex, all right? So let's talk about the contract. What the heck is a contract? So Nadex brokers, we were taking calls and puts, right? Calls to go up, put to go down. On Nadex, there are no calls or puts, no calls or puts. Instead, we're buying and selling contracts, all right? So if we expect price to go up, on Nadex, we're not, instead we're buying a contract, all right? Just a little terminology difference, right? If we expect the price to go down, we're selling a contract. Now, there's a little bit of a terminology issue there. If you've never, you say, well, we're selling a contract, we haven't bought it yet. Well, think of DSD that you guys are all in, right? We all sell in DSD first before we buy it, and you can do the same thing in the markets. You can sell before you buy. All right? So if we expect the price to go down, we sell a contract. The points in between. If we're buying, and you guys got to pay attention here. If we're buying, the buyer thinks the asset will close above the strike price. Makes sense, right? We're buying. We think the price will go up. We think the asset will close above the strike price. Easy. But for the price to go down, the seller thinks the asset will close at or below the strike price. Read that again. At or below the strike price, all right, for it to sell. So a dead tie, if the market closes exactly at our strike price, it favors the seller. The seller would win. All right? So down, or lower. Okay? Up, if we buy it, it has to end higher. Okay? There is no get your money back on a tie on Nadex. You either benefit from it if you're the seller or get screwed by it if you're the buyer. But you know that going in, right? So that's the contract. We're either buying contracts, up or down, right? So let's talk some more about the contract because it's fun. The value of a contract is always $100. Always $100. Always exactly $100. Never anything else. So market conditions determine how much of the risk the buyer and how much am I going to pay for the contract? How much are you going to pay for the contract? So, or to enter to get in on the contract. As an example, if a contract is available to buy for $35, or let's try that again. If a contract is available to buy for $65, $35, oh my goodness, maybe I should burp again. Jeez. If a contract is available to buy for $65, the buyer is risking the $65 to buy it, all right? If they lose, well, they'll lose the $65. The seller, on the other hand, is risking the difference between the $100 contract and the buyer is. So the buyer is $65. The seller is risking $35 in this case, all right? Now, if the buyer wins, they'll get $100. Oh, yeah, it was only a half burp. That's right, Chris, only a half burp. If the buyer wins, they will get $100, okay? $35 profit, 5, they got 100, right? So they got a $35 profit on a $65 risk. They made a 53.8% return on that trade. On the other hand, if the seller wins this trade, they too would get $100. The winner always gets $100, but they only risked $35. So they'd make a $65 profit on a $35 trade, and they would get 185.7% return. So you see the difference, and you see how the return can be either less than a non-Nadex platform or more, right? If we get in at a lower cost, if our risk is $100 on less risk, our return is going to be a lot higher, right? So here's what the Nadex platform looks like. All right, here's this at some point in time. It looks like it was March 30th, a few days ago. And here's what the Nadex platform looks like. Now, you'll see we have a contract here. What pair are we looking at? And the contract column shows a lot, all right? But just take a look at this picture. We have a contract, we have a time left, we have an expiry, a bid size, a bid, an offer size, and what they call the indicative index. Don't let the indicative index scare you away. Let's look at what some of these mean. So the contract is this first column here. The contract is the currency pair, commodity, or stock you will be trading along with the available strike price. All right, so take a look on our non-Nadex platform. On our non-Nadex, we can only enter at the price that it is right now. We click the button, we get whatever price it is, right? But on a Nadex platform, we have our asset, the Aussie dollar, the Australian dollar versus Japanese yen. Then we have a strike price, 92.00, and then we have an expiry time. And this is Nadex asking us a question, all right? Will the Australian dollar, Japanese yen be at a higher price, be greater than 92.00 at 7 p.m.? The non-Nadex platforms were usually in GMT, right? Nadex is based in the U.S., so Nadex is in Eastern time, okay? So 7 p.m. is 7 p.m. Eastern time, and again, you can go to that timeanddate.com and do your time changes, right? So will the Australian dollar, Japanese yen be trading higher than 92.00 at 7 p.m.? Yes or no? Okay. If you think the answer is yes, if you think it's going to be higher, then what do you want to do? What do you want to do, guys? All right, if you think it's going to be higher at 92, right, you want to buy a contract, right? You want to buy this contract specifically. If you think it's going to be lower than 92, then you want to sell the contract, all right? Now, take a look at what we have, though. We have two options, right? Sometimes there'll be more than two options, but here's these two options. We could get in at a strike price of 92. We could say it's going to be higher than 92, or we could say it's going to be lower than 92, or we have the same pair here. We could say it's going to be higher than 91.80, 91.8, or lower than 91.8. We can get in at the strike of our choosing, all right? Not every strike is available. We can't pick 91.99 and 91.98, but they do have multiple strikes available, and we get in whichever one we want. So what's the benefit to that? Say that options domination, the price is going to be higher than 91.9 at 7 p.m., all right? 91.9 at 7 p.m. Well, what if the price already started moving up, all right, against you a little bit, right? You know, you could take this trade at 91.8 and get a strike and get that strike price that would still win if they win, right? And it gives you an option to still get into trades you potentially missed on your non-Nadex platform. It also gives you flexibility to get in at difference, all right? So that's what it is. Remember the question. Will the asset be trading higher than this strike price at this time? Yes or no? Yes is a buy, no is a sell, all right? Now, this is just the time left before the contract closes out. This is the date it expires. Don't worry about the bid size or offer size too much. But now, how do we come up with how much a contract is worth, all right? How do we come up with how much a contract is worth? That's based on the offer price and the bid price. The offer price is the price you pay if you wanted to buy one contract. All right. The bid price is how much you can sell one contract, especially when you forget what slide you're on. There you go. So the offer price is how much could I buy one contract for, right? So if I wanted to be in on this Australian dollar, Japanese yen, and I thought the price would be higher than 92.00 at expiry, I could buy it for whatever the offer price is, okay? The offer price is blue, like a buy, right? Like a call, kind of, blue. So I could get in on a buy on this contract for $29, okay? Now, if I win this contract, if I bought this contract and the price closed above 92, what would I get? Come on, guys. Come on. Money, 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 money. Yes, you get money, sure. Okay, so good answers. Yes, you would get $100, 71 of which would be profit. The 100 minus the 29 you risked, right? Now it's a little bit different if you were going to sell. If you were going to sell this contract, you were going to say no. The prices don't going to be under 92 when it closes out. Then but this is the price that we can sell the contract for. So our risk is actually, on a sell, our risk is actually 100 minus the bid price. All right, so if we wanted to sell this contract, our risk would be 100 minus the bid price, 21. So if we were going to sell this contract, our risk would be 71 in this case. And or 79 in this case, sorry. Our risk would be 100 minus 21 would be 79. Our payout would still be 100, so we would potentially make $21 on a $79 risk. All right. So you got to remember that for the bid. The bid, your risk is 100 minus the bid if you're selling. Buying, your risk is just whatever the offer price is. All right. Now, how do you determine? Let's see what the slides actually say. Yeah, let's go back here. And what these prices are. It's based on what they call the indicative index. And the indicative index is just a fancy way of saying what is the asset trading for right now. All right? What is the price right now? Now, in this case, is price right now in this case is 91.895, right? So remember that in order to get in on a buy to end above 92, we can do it for $29 with the chance to return 171 profit. Why? Because we are out of the money. This contract, when we're out of the money, right? We would need the price to move, what, 11.5 pips up, actually a little bit more, 11.6 pips, that final tick. Remember, the tie goes to the seller. We would need it to move up quite a bit to be in the money, right? So we are buying this at a disadvantage, right? We are starting out losing. That means that we can buy it at a cheaper price because we're starting out losing. The seller, on the other hand, we said the seller has to risk 100 minus 21, $79 to make the same 100. Why? Because 91.895 saying it will be below 92. They're already in the money. They're winning before they start, right? They start, and if it closes right where it's at, they win. If it keeps going down, they win. if it goes up, but not up too much and stays under 92, they still win. Right? They have a lot of ways to win. The only way we win is if it goes up, crosses 92, and stays above 92, right? So we'll look at this in a minute, but the price, the risk price on a contract is roughly equal to your probability of winning the contract, all right? So Nadex is saying you have roughly a 29 of winning this contract if you buy it, and you have roughly a 79% chance of winning the contract if you sell it, all right? Do those add up to 100? No. That's because it's rough, all right? The market determines the price, so, they're just roughly correlated to the probabilities. It's close. But again, if you were to buy this one, you need a 10 lower. But take a look. We have another option. We have an option to get in at 91.8 if we want, right? 91.8. And if we say it's going to be higher than 91.8, this time 5 is in the money, right? It's not out of the money like it was in the last one. This time it's in the money, and we're happy, and we're winning before we start. So now we're going to have to risk more, a lot more, to get this contract because we're already in the money, right? So now instead of risking 29 when we're way out of the money, we have to, if we're going to buy the contract, because we're already in the money by 9.5 pips, right? So that gives you an option. So the more disadvantaged you are, the higher the payout, but the less likely you are to win it, all right? Assume every option's domination school and all that. This could be one of those situations where maybe the price drops away from you and you still take it because your payout's really high, right? If OD you get a big return. Or maybe OD pops a signal at a price that you're far away from anyways, right? And you're waiting for the entry or whatever, and you just take it in Nadex instead at a higher payout percentage, all right? So that's where you can benefit off different options, different payouts, and different risks, and you have some flexibility there. So that's kind of how that works. Again, indicative price is just your current price, and we're looking at a strike here. So give me a yes or no if that makes sense. All right, lots of yeses this time. All right, getting better at this. Not bad, not bad. All right, so we'd already looked at the Nadex terms, all right? So the big ones are the offer price, the price you pay if you buy one contract, could you sell one contract for. So remember, 100 minus the bid price is your risk on a sell, all right? The indicative index is just the actual price. Okay, so let's look at a few Nadex notes. Again, the price of a contract is roughly in line with its probability of winning. So if a contract costs $65 to buy, the buyer has approximately a 65% chance of winning the trade. Where the price is at, if you don't like where the price is at, you can set what's called a market order in Nadex, and that will execute if it reaches the amount you set. So if you say, well, I could buy it for 65 now, but I'm only willing to risk 55, all right? Well, you can set a market order for 55. The price of that contract gets down to 55. The broker, Nadex, will automatically execute it for you and buy that contract. All right, so that's an option you have. It's to set a market order. Now, of course, that market order might not get filled. Right? If the price never gets to 55, well, you just don't get it. So if it doesn't reach your set price, no contract purchase will be executed. Okay? Again, you also have the option to close the contract early to lock in profit. So maybe you're, say, 120% in profit halfway through the trade, and you say, well, I don't want to risk it turning around. Maybe you look at maybe you're looking at your charts and you see something coming up that might make it might cause it to turn back around. This is good. I'm going to take my profit now and, be good. All right. So that is an option, and it is beneficial sometimes where it almost never is on the non-Nadex platform. Can you hedge your Nadex against a non-Nadex for same trade to get an arbitrage profit? Ooh, theoretically. Anytime you're looking for an arbitrage profit, you're looking for for one loss or for one win to be bigger than a loss, right? And guarantee that you middle it, basically. That's a strategy that you'd have to look for. Can it happen? But it's going to be based on specific market conditions, and you're going to have to be, you know, will it happen a lot? Probably not. Again, the direction is what matters, not so much as the direction. So, but maybe not common. All right, can you win on a free demo account? Can you win on a free demo account, and would you recommend starting out with a free demo account? Yeah, you can win on a free demo account. Fake money, right? So, you know, your fake balance would go up, just like your real balance would go up on a real account. Yes, you want to start with the demo account, especially on Nadex. All right, on the non-Nadex brokers, it's up to you. You can probably get away with demo trading for a few days on a non-Nadex broker. You're gonna want to demo longer than that and figure out what you're doing. All right. So yeah, you can take an early profit. Yes. You can take an early profit. You can take an early profit on a call, on a put and call. Yes. So, you know, if you try to hedge some way, you could try to hedge that way, Troy, with the early profit thing as well. All right. So Nadex fees. So whereas before, yes, I recommend you have both, but you've probably seen non-Nadex is simpler, right? You know, by the time we get off the call, you should understand now. So, yeah, it's easy. It's going to be easier for you, right? It's a yes/no proposition. Are you at or better than the strike price? Yes or no? Take it, right? You can use some of the charting techniques as well. So, yes, I do recommend it, but you know, you're gonna want both. So I would demo on Nadex, then either demo or, you know, you can put a small amount in a broker in a non-Nadex and play around. Okay. So Nadex fees. Nadex charges both the buyer and the seller of contracts a small commission for the trade. So this is how Nadex makes money. They charge you 90 cents when you enter a contract. So for each contract, they would charge you 90 cents. If you bought 2 contracts on the same trade, that's it. Okay. If you're trading more than 10 contracts on a single trade, which most of you won't be, because you know, it would be somewhere between you know, call it $20 and $80 times 10, right? So it'd be pretty big trade size. But if you're trading more than 10 contracts on a single trade, the fee is capped at $9. All right, you'd have $9 in and $9 when you exit. Would be an $18 max fee. Now, if your contract closes out of the money at the time of, you're not charged the second 90 cents fee, but you are still charged the first 90 cent fee. All right, so that's how that works. Let's see. All right, let's take a look here. All right, so now that's Nadex for you guys. And now we get to look at the recommended brokers. This is what a lot of you wanted to see, right? So recommended brokers. To take advantage of all the all Signal's OD offers, it is recommended that you have funded accounts with at least 2 non-Nadex brokers and Nadex. All right? Why in a minute. All right? So when we recommend brokers, all right, the most important thing is their track record. All right, their ease of withdrawal and extensive testing. All right, there's a lot of bad brokers out there. So don't join just any brokers because their payouts, their bonuses are higher. All right, remember there are a ton of bad ones out there. So you only want to use those that have been tested and vetted by others. All right, so hopefully I did this job for you, and you know, you'll be able to just use what we recommend. All right. So once we know that a broker is good, a broker is going to pay us, they're not going to run away, they have enough money to pay us, we want to use the legit brokers to maximize the following: the available assets, right? We don't want to miss signal trades. want to be able to take as many of them as we can. So the brokers that we use have to offer the assets that we need to be able to trade, right? Payouts. So greater payout percentages decrease your required win rate and can drastically increase your profits, right? If you're getting 80% or 82% or 81% payouts as opposed to 70, obviously you're going to make more money and you have to win less, right? And bonuses. If you choose to take a bonus, then lower trades are extremely advantageous, right? You get to clear the bonus quickly, you have a better chance of clearing the bonus, and you get to withdraw sooner. All right? So that's what we're looking for. Now, here's the recommended brokers. The first broker is called Go Options. Now, this is the broker, non-Nadex broker, by Options Domination. All right? Now, I have to note, I haven't personally tested Go Options, but assuming that DS, if not better, or OD has just as good as it, if not better, as testing it. So we're gonna go ahead and say it's good. All right, they've said it's good. That's good enough for me. So they've worked out with the broker that if you're an Options Domination member, you'll get exclusive bonuses with no trade requirements. So you can take the trades, have no trade requirement, and withdraw the winnings right away if you want. And those are pretty much risk-free. If you take a normal bonus, if you take a deposit bonus on Go Options, you're still going to have a trade requirement, and that's all listed in your Options Domination back office. They typically have 48-hour payouts. Again, haven't verified that personally, but that's what they say. The requirement, but now note this, all right? Note this. The requirement on the risk-free trades that don't have, the requirement free risk-free trades, that's a lot of frees, but the risk-free trades that don't have a trading requirement that you get because you're a member of Options Domination only apply on your, all right? So if you deposit $500 initially, and you take whatever they offer, call it, I think it's $125 in risk-free trades. Well, later on, if you go to deposit $2 or $3 or $5 or $10,000, you're not going to get more risk-free trades with no trade. So it's a bonus with a trade requirement, but you won't get the absolutely risk-free trades a second time. All right. So in my mind, depending what you're planning on doing, you know, if it may be better to start with other brokers and benefit more from the bonus later when your resources allow. All right. Now, all depends on your personal situation. If you need the risk-free trades or you need the free money to get moving, then by all means take it. All right. If Go Options is your favorite broker out of the ones we look at, by all means take it. In my mind, I'd rather get the most I can out of what OD has, you know, set up for us, and maybe it's better to use those risk-free trades later on. Your call, all right? Just something to think about, okay? So for this one, for Go Options, you're going to use the link in your Options Domination back office. That way you sign up through Options Domination and you qualify for bonuses, all right? Got to use the link through the back office. Don't just go through a GoOptions.com, all right? Link in your back office. It's under the foundation training under brokers, okay? All right. Now a couple more brokers. So here's brokers that I have personally tested, I've personally withdrawn from, I've personally funded, I've personally traded with, etc., etc. And these I feel comfortable recommending. All right. First one is called Bloomberg's option. Why are we looking at Bloomberg's options? This is actually the one that I took the trade on initially, and we'll look at that trade in a minute just for fun. But the reason is because they have higher payouts than others on most of the available assets. Most of the available assets they have. All right. Now during the day they have quite a few assets, quite a few. At night the number quite a bit. So you're looking for Bloomberg. You're looking at Bloomberg's mainly for what we call the major pairs, dollar pairs, and some minor pairs. And the idea is that we want to get what trades we can on Bloomberg's because we get a higher payout. All right. get a higher payout on our wins when we can take them here. They also have a much lower trading volume requirement on bonuses. All right, so almost every other trade requirement on bonuses. Some are 40, some are 50. Bloomberg's is 16. All right, so it's a lot lower. So if you're looking to take a bonus, this may be the place to do it because you have a much lower trading requirement, right? 16 times instead of 30, 40, 50. Recently tested, it's fast, no problems with withdrawing. They also offer PayPal as a deposit and a withdrawal method, right? The typical methods are credit card, bank wire, stuff like that. Bloomberg does offer PayPal as a deposit and withdrawal method, and I've used that as well. So on eBay, right? Might be a good way to fund and get paid and all that. The minimum deposit on Bloomberg is $300. So, that's the minimum you have to put in. And again, we don't want, Atesh always says, don't be trading with, you don't want to be trading with $10, $20, $30 account anyway, right? Because A, it wouldn't be worth your time, even if the broker let you make a $2 trade. What are you going to do? You're going to win $1.60, right? If you win, and you're going to lose sometimes too. You're not going to be, so Bloomberg does not offer a demo without a deposit. Bloomberg actually does not offer a demo at all. All right, so that's why it's not a perk on this list. No demos on Bloomberg. All right. So minimum deposit of $300, and if you want to join Bloomberg, which I highly recommend because of the higher payouts and lower bonus, my link is right there. JoinBloomberg.com. All right. I told you guys at the beginning that yes, I will get a commission if you do that. All right. So keep that in mind. JoinBloomberg.com is how you would join Bloomberg. Pretty easy, right? The third and final recommended broker that we're going to look at are popular ones. You've probably heard of it. The reason for Boss Capital is the large number of assets that are available at all hours. All right, you won't miss very many trades at all on minor pairs, especially at night, because they continue to offer them. All right, they offer more pairs than Bloomberg. Just for comparison's sake, Bloomberg and Go Option are going to offer pretty much the same pairs. All right, they use the same readout. All right, so basically the same there, but Bloomberg has higher payout percentages typically than Go Options. All right, more assets, larger number of assets available at more hours of the day, so you won't miss trade. They have good bonuses, good bonus offerings, including risk-free trades. You'll have to talk to the account manager you get when you sign up and see what. They do have a demo account available once you deposit, okay? And the minimum deposit's only $200. Okay, so it's kind of like a Nadex deal, right? Probably going to be depositing anyway eventually, so why not deposit and get your demo account? This demo account doesn't have Bloomberg, or unlike Nadex, sorry, most on Bloomberg. So those are again, as you probably guessed, the link is joinbosscapital.com. That's how you join Boss Capital. So join Bloomberg, join Boss Capital, and Go Options you would join through the OD. Those are the three brokers that we're looking at, or that I recommend personally. I highly recommend two of them. All right, so if you're going to join, I highly recommend having more than one. Sometimes some don't offer trades. Sometimes some go down. They're kind of, I don't want to say glitchy, but sometimes the price readouts go down for a couple minutes at a time. On Boss, it really doesn't, but you want two brokers, one as a backup, and so that you can take advantage of all these different things. You'll learn which pairs offer the best payouts on which broker at which times, right? Learn that pretty quickly as you're doing it, all right? You just don't want to trade. You want to maximize your value out of that trade, and those three brokers should help you do that, all right? So Boss Capital, because of more pairs, is definitely one you're going to want. What times I trade whenever DS gives me, or whenever OD gives me a signal. So If OD gives a signal, I try to get it. Obviously, I tend to get more at night because I'm home on the computer, placing orders for DS, right? But that's kind of how that works. So that's kind of what we're looking at. So been on here quite a while, man. 2.5 hours now. Wonder how many people have stuck around. I can't see at the moment. Attendees. Let's see here. We'll make it around. That's not bad. So Troy's still around. He better be, otherwise I'd have to go get him. Half a recording, right? Okay, so let's have a short Q&A session. We already had a mini one at the beginning, but I don't want to keep you guys on here too long. So let's have a mini Q&A, 5 questions. So go ahead, start posting your questions, and we'll answer them. If I only have $500 to risk with OD, which broker should I go with to start? Good question. Okay, so if I only had $500 to risk with OD, personally, it's kind of a balance between payout and number of trades available, right? I would probably say go with did sound die? Did sound die? Oh, okay, cool. Awesome. Stupid sound. So I would probably go with the one that offers me more assets at the moment. I can take more trades, build up my balance. All right. I'd probably start with Boss Capital. Just my guess. It's really up to you. Maybe you say I don't want to have to take as many trades and I want a higher payout. Start with Bloomberg. You're not going to go wrong either way. All right. Let's see here. Let me scroll up. Do you recommend 2 computers or 1 for trading? One computer's fine. 2 monitors doesn't hurt to be looking at the charts, but there's nothing wrong with looking at the chart and then alt-tabbing over back. Please give us the PowerPoint slide presentation. Yes, there's some way to do that. Wait for me to stop sharing the screen, and I'll give you guys a link to the PowerPoint presentation. The minimum trade on Bluebex is 20. For the longer term trades, it's 10 for the short term trades. On Boss Capital, I think it is either 20 or 25. And then again, lower for the short term trades. Yes, Krista, I'd say Boss, but you're not going to go wrong either way. It's whether you want higher payouts or the option to take more trades. Alrighty. Let's see here. Chat grows pretty fast. Now I know what Roger means. Are the 2 brokers you recommended, are they in the OD back office? No. The only one is Go Options because that's the only one that OD has made a deal with to get you guys special stuff. So that's the only reason there's only one back there. And that's why for Go Options, I didn't give you a link. All right, I didn't give you a join gooptions.com, right? Because it's a link in your back office for Go Options to get the bonuses. Okay. On the asset, which one is? Yeah, let's see. On the asset, say the Great Britain pound versus the dollar. Which one is the moving asset, and which is the stationary? The first one in the listing. So Leslie, it's a ratio. All right, they're both moving. The ratio of a Great Britain pound to the U.S. dollar says how many U.S. dollars can I get for 1 Great Britain pound. All right, so the ratio of the value of those 2 currencies in respect to each other. So it's not one moving and one staying stationary. It's them moving with respect to each other. All right. Let's see if I can get down here. Does Boss Capital have an app for the iPhone, iPad, and Android? I believe they do, and I think Boss Capital does as well. They pretty much all do. Go Options does too. What When placing a Nadex market order and make a purchase of more than one, if I say example of 50, would I sell the contract per purchase together for the amount I specified? William, that'd be up to you. You can liquidate part of a position or the entire position. All right. Entirely up to you. Let's keep going. We'll go a few more than 5. All right. How often is it recommended to withdraw funds from Boss Capital? Joe, from any of the brokers, it's really up to you. It depends how much profit you make, right? There's no urgency to get it out, but if you need it, you take it. Your trades based on your money management, you leave it in there. Alicia, what's considered a long-term versus short-term trade? All right, so in the non-Nadex brokers, anything 5 minutes or under is considered a short-term thing. Roughly, say 15 minutes or higher is considered a long-term trade. All right, there's anything like 15 minutes to an hour is considered a normal trade. You can also take trades that are, a week long or multiple days long or a month long or 2 months long. How do you know how to use the signal for the different brokers? Rona, it becomes a what can I get, where do I get the best deal? All right, so if only one of the two brokers offers the pair that we want to trade, well, then the decision's made for why we have two to make sure we can get it, right? If the broker's offered on both, you take it on the one that's the higher payout. Okay? Let's see, Nadex will be adding more trades soon. Yeah, Larry, that's what Atesh said. That's what Nadex said, but who knows? That's pretty relative. I wouldn't expect it. I wouldn't expect a bunch of pairs to just pop up soon. And especially not because of us, because we're all taking it on the same. So let's see, what is the link for? Yeah, so let's use this slide presentation again, just since we're on it. So I'm back. Oh, sorry about that. So the link for boss.com, to whoever asked that, Susan, and then the link for Boss Capital is joinbosscapital.com. All right. Is your tax benefits to all right, let's go up and so I don't miss it. That's for the Android. All right, thanks, Audrey. So that's the answer to that one. I've heard members having problems with withdrawals on big amounts. Is that true, Joel? That's why it depends on the broker you choose, right? That's why you have to pick the right broker. With the brokers listed here, you shouldn't. I don't have any idea with Go Options. I've never used them or withdrawn from them. But from Bloomberg and Boss, no problems. All right. Let's see. Marius, do I have a spreadsheet that tracks trades? Sort of. It's not as fancy as what you're referring to for the selling. We can work on that. Let's see. Is there tax benefits, Nadex versus non-Nadex? Can't really, I'm getting a little bit better answer than our Nadex guy did, but again, can't really get into the tax things. I don't know if the international non-Nadex brokers send you anything. That being said, you're still obligated to claim it on your taxes, right? Same with Nadex. The tax rate, link for Bloomberg's, join Bloomberg's.com, join bosscapital.com. Lost me. Is Nadex only for U.S. or international? Also, Nadex is for the U.S. and there's 40 other countries. You'll have to go look on the list on Nadex to see what those 40 countries are. Alicia, am I having success using OD singles with your Boss or Bloomberg's account? Both. And that's again why we're recommending two. All right. I like to take the ones that I can done. I like to take. I might as well half burp now too, right? Can't that'd be good. I'd like to take the ones that I can take in Bloomberg's because it's a higher payout. The other ones I take in Boss Capital. All right. So use both back and forth. Alan, I'm back. Yep. Thanks, Joel. Thanks. Alrighty, so let's see. We did have a question of how do we get the slides? Let's see here. Share slides. Share download link. And these slides won't have to share the download link without paying. Okay, so what I'll do is I'll put the slides in the I'll put the slides in the presentation. I'll put the slides in the email that goes out to you guys after the meeting. Once I get put a download link to the slides in there too. And then you guys can have the slides. Okay. Now, if that's all the questions, Tatiana, what we're gonna do, and leading right into that, is when we close out the training in a couple of seconds here, yes, you should, of the, let's actually go to the slide, all right? Well, first of all, guys, most of you are members of Options Domination, all right? If there were some members that aren't members of, or if there were some people that weren't members of OD on here tonight, your first step is to get back to the person that referred you to the training, all right? If I'm that guy, just a play on the legacy level of OD, all right? But guys, only use that if I am your sponsor. If you have another team in DSD, you know, if someone else sent you here, don't use that, all right? We're not trying to steal anyone. Join under the right person, all right? Most of you are members of Options Domination anyway, but for people watching the recording in the future, if you want to use this as a training asset, guys, if you're watching it, you're not a member, join under the right person. If that's me, cool. If it's not, even better. All right. So thanks for attending. Will someone upload them to the file section so we can access? Yeah, Ellen, that's a good idea. I don't know if I can. None of the options groups are mine. You know, they're corporate or they're someone else's. So I don't know if I can do that, but I'll at least post them on my Facebook wall as well. Thanks for attending, guys. When the webinar closes, it should direct you to a survey. It's pretty short, but fill it out honestly so that we can help plan future training if we need to. All right. If it doesn't pop up a survey, because who knows, then there's another link that you guys can access the survey at too. It's earnwithmatt.com/webinar survey. All right. No, I gave you guys a lot of links, but hopefully that getting a little bit more now. You guys can play with the charts, go through some of those trade setups, look for some of those price action setups, and verify some trades, take some trades, make some money, and we'll be good to go. All right. So you guys have a great night. I'm going to close this out so Troy can stop recording. All right, guys. You have a great night. Hit me up if you need anything. Talk soon.